The mic is not working. Okay. There we go. Test. Sorry if the mic wasn't working. Okay, I fixed my mic. Okay, that probably ruined the beginning of the stream. Oh well. But anyway, here's my Moomoo portfolio. It's actually down pretty bad on the day. We are down 3.29% on the day, but I'm really not too worried because most of these stocks are just having a healthy RSI retrace. Like a lot of these companies hit all-time highs like the previous day, like Powell Industries, Comfort Systems, both hit an all-time high yesterday. And well, today that position's down $900. This one's down 700. But still, I'm not worried at all because if we go to our year-to-date performance, we're still crushing the S&P 500 in this account. We are up 71% versus the S&P 500 up 7.4%. We're also down pretty bad in our Webull portfolio today. In the top left, that's our open profit and loss. I love being fully transparent. I'll share with you every stock I own, how much I'm up and down and stuff. So open profit and loss, we're only up 20% all time, which isn't exactly great. And just on the day, we are down 2.7%. And a lot of that red is from AMD and PSIX, which is currently down 40% just in one day. So they had some earnings and the earnings were really bad. They missed on revenue, they missed on net income, so the stock tanked. And here the stocks were kind of green on the day. It's like the defensive names, like a Progressive, an AbbVie, a Sprouts Farmers Market, Calmain. These kind of defensive names are up on the day. AbbVie is one of my favorite stocks to buy on the dip. They're a phenomenal, growthy healthcare company. And then we have our Robinhood account. This is in the top left called our dividend-only portfolio, where every stock in here pays a dividend. A lot of these you've probably heard of before, like Google, McDonald's, Meta. I got Constellation Energy, United Rentals, and this is our total percent change in every stock. So we are green on every holding except for McDonald's. We are down on McDonald's, but our main winner has been Google. Just in 1 year from exactly 1 year ago, Google is up 142%. And we're only up 137%, which is still amazing. Like what I'm trying to say is I didn't time the bottom. I didn't buy the dip on Google. I bought them when they were just at a fair price and they've just done so well this past year. Oh yeah, here's our year-to-date performance. We're up only 1.1% year-to-date. And over the past year, we are up 16%, which definitely does not outperform the S&P because the S&P 500 is up 6.9% year-to-date and they're up 26% from exactly 1 year ago. So even the boring S&P 500 is up 26% in a year. That's incredible. And then we also have a Roth IRA. A Roth IRA is just a tax-free retirement account. We started this exactly a year ago, pretty much. And we haven't done too well, but we do have some cool names in here. Innodata is down 10% on the day, but check them out on the week. They're up 101% on the week. So yeah, we're up 175% on them total return. But even still, we are down all-time 3% because we started this a year ago. We're trying to bring the growth back. So let me know if you have any suggestions. I'm definitely trying to condense down the portfolio because I have way too many holdings for sure between all my accounts. But yeah, I actually wanted to go over one company in particular. Oh, hey, watch out for that guy in chat there. So anyway, I wanted to go over Meta stock right here. Yeah, I'll never follow you, DM you, I sell nothing. Watch out for people impersonating me. So Meta is genuinely a steal of a deal, in my opinion. Not financial advice, of course, but if you like WhatsApp and if you like Facebook and Instagram and Threads, why not own the app that owns that? Because they're collecting $50 per year per Facebook user. That's their Facebook ARPU, or average revenue per user. Can you believe it? Let's see what else. Meta collaborates with Qualcomm and OpenAI on AI wearables. So yeah, if you haven't heard, Meta has the Meta Ray-Ban glasses. I love what they're doing with their smart glasses. I think everyone's going to get in on that game. Apple's going to have their own smart glasses. Google is actually partnering with Gucci right now to make Google smart glasses just like Meta's. So I think they're the first to the market, which I'm really impressed about. But one thing being questioned on Meta, though, is how much they're spending on AI. If we go to their cash from investing activity spend, they're looking the past just 2 quarters. They spent $34 billion, another $34 billion. That's spending more than they're making because they only make in net income, 22 to 25 billion of net income a quarter. So they're, for the past couple quarters, are spending more than they're making. So they actually have a net debt position for the first time ever. But that's not scaring me out of Meta. They have incredible users. They have 3.54 billion daily active users. they have this app called Threads. Threads nearly has now the same amount of daily active users that X does. And they're now introducing ads to that app, and they're adding ads to WhatsApp after they acquired WhatsApp, and their original slogan was no gimmicks, no games, no ads. Now they're putting ads on the app. But hey, as a shareholder, I'm not going to complain. And here's why Meta fundamentally is cheap. On a forward PE, which means price to next year's net income, they only trade at 19 times next year's net income. Seems pretty fair to me. For the users that they have, for the advertising business, they're getting into AI. They have their own LLM. They're kind of behind on the LLM, like Google Gemini, ChatGPT. They're winning, but I'm still not selling out of Meta. Hey, what's up, Ben? Oh yeah, here's the one that here's the Meta position right here. I do own some shares. I'm only up 13%. Yeah, I got 5.1 shares of Meta. I like being fully transparent. I'll share with you all my stuff. So, hey, what's up, Ben? He says, I'm the one that gave you the Innodata pick. Yo, shout out to Ben. So he says, can we look at DLO stock, D local? Let's do it. And then, hey, what's up, Terrence and Marcus, Japan, Jackson Hoover. Dude, thanks for the 15 roses. Yeah, we'll look at NOW after this. For real. Dude, thanks for that. I appreciate you. What's the app? Yeah, it's on my profile link there if you'd like to get this brokerage. It's where you buy stocks on. It's an affiliate link. It's a broker called Moomoo, but you can just type it into Google, though. Anyway, here's D-Local. They're worth $3.8 billion, and they're actually really cheap in a financial or net income point of view. They only trade at 19 times net income and only 15 times next year's net income. So when the PE is lower than the current PE, or the forward PE is lower than the trailing 12 months PE, that means there's a lot of net income growth they're about to experience. Let's check out the forecast. Yeah, look at that. Net income is going to go from 42 million to 57 million year over year. And notice they beat on net income earnings every quarter. The orange line's what the analysts project, and they beat by a good margin every quarter. And on revenue, analysts expected 296, they did 337, and they kept. Wow, that's a good margin. So revenue's up 65, net income is up by 87. So this is margin expansion. Yo, what's up, Dave? Yeah, hey, this is not a recording. Maybe I sound like AI or something, but no, hey, this is definitely live. You can check the time and the stock price. If I'm going over a stock, you can check the price and see if it's the same. But yeah, anyway, D-Local, here's their website right here. I guess they do like a payment solution. So they're a Middle East. So actually, wait, where are they headquartered? So notice, I actually don't know what country this is or how to pronounce that. Uruguay. Oh gosh, someone's going to make fun of me for mispronouncing that. But in the very middle, you can kind of see the country. So they're not a U.S. company. That's probably why the PE ratio is low. These foreign countries get traded at lower multiples. And yeah, look where the revenue comes from. It comes from other countries, Brazil, Mexico, Argentina. Sorry, let me get my tea here. So yeah, that might be why the stock has a lower multiple, but this is a cool international play if you're looking for an international transaction kind of company with great net margins and great revenue growth. 65%, this is in US dollars as well. I'm actually really liking D-Local, especially at a 15 forward PE. I mean, can't go wrong. All right, so hey, thanks again, Jackson, for all the gifts. He says, can we look at ServiceNow? This is one of the main software stocks that are falling because well, let's see. ServiceNow proposes $4 billion debt to refinance Arminus acquisition. So yeah, they just acquired another cybersecurity company called Armis, but they are a software enterprise software subscription model company. Okay, sorry, my thing's a little slow here. ServiceNow targets 30 to 32 billion of revenue by 2030. So let's see what their current revenue is. So that's some pretty good guidance. 30 billion of revenue. Well, what's the annual revenue right now? So look at full year 2025. It was 13 billion. So in 5 years, they're going to double their revenue. If they can pull that off, they deserve a high multiple. And well, they have a high multiple. This is the one part that scares me. Even though the stock is on a dip, the forward PE is still a slight bit expensive. A 41 forward PE. So I feel like that could still maybe stretch down to a 35 or a 37 before it fully bottoms out. and send this down another 10-20%, but I think that that would be the bottom. So I wouldn't go crazy buying the dip yet. I'd nibble on them, but I wouldn't go crazy buying the dip yet. But I am super impressed with this revenue growth. If we just zoom out, literally quarterly, by the quarter, not just every year, but every quarter, revenue's at a new record. That is phenomenal growth. That definitely deserves a high multiple. And plus that 2030 guidance of, what was it, 30 billion, 32 billion, up from 15 billion for the full year 2025. Incredible. Wow, look at all these other news. ServiceNow expands AWS partnership after marketplace transactions surpass 1 billion. So that's working good for them. There's a lot of bullish news. ServiceNow launches autonomy, security, and risk platform integrating Armis and Visa for AI agent governance. Pretty cool. So anyway, that's a software company. They, like a lot of software stocks, they're all on a dip right now. Okay, hey, what's up, Huff? I'm a little behind here. I do apologize. What's up, Terrence? And let's see, what do you think about the drop at McDonald's? Yeah, unfortunately, all the food companies are experiencing this little downtrend, and I don't think it's justified. I'm actually buying the dip actively on McDonald's because McDonald's is a little different than your average restaurant stock. They're really a real estate and royalty company because they own the land under 80% of the stores, and they collect a royalty. So check out like Wendy's stock, RIP Wendy's. Wendy's, so this is like a big competitor to McDonald's. Wendy's is the same prices they were back in 2008 when McDonald's is only a couple percent off its all-time highs. So Wendy's is down bad. And what I'm trying to say is this is a whole industry-wide issue. It's not just McDonald's that's struggling. Look at Jack in the Box. Jack in the Box is the same prices they were back in the year 2000. Isn't that sad? So they've done nothing. They've destroyed more value than created. Krispy Kreme is at an all-time low. And not even just the restaurants like the QSRs, but also the actual like packaged goods like General Mills, who owns a bunch of cereals. And check out General Mills. I love how diversified that they are. They're in snacks, cereals, convenient meals, pet, dough, all that. Look at how bad their stock is. So the best way to buy the dip on this in the food industry, I think, is to buy McDonald's. So yeah, I'm actually down 2% on my position, but here are my most recent buy orders. I've even been buying fractional shares in McDonald's. I'm always a fan of buying fractional shares. All right. So let's see yeah, Casey, McDonald's is cheap. How are you sharing this live? Hey, I'm just streaming from my computer. I'm Apple playing my phone to my computer, and then I'm just streaming from my computer. So, all right, next up, XTX said, is Shopify stock a good buy right now? That's a big Cathie Wood holding, and I love this company. So, as we know, these super investors have to make their portfolios public, like Nancy Pelosi. But Cathie Wood, Shopify is a big holding in her portfolio. Yeah, so it's 2.85% of her ETFs. And check this out. Shopify did just report earnings and gap down on earnings. But here's why I am a huge fan of Shopify. They had a one-time adjustment to their net income, but they're just expensive. That's the only bad news. Like even on this dip, the forward PE is still a 63, which makes it still expensive even on this dip, a 63 forward PE. But here's why they definitely deserve that kind of multiple, because they have a fortress balance sheet. Shopify actually has no debt. Shopify is a debt-free company. They have $5.7 billion of cash, no debt. And check out the revenue growth. This is by far the most impressive metric. Like every quarter, it hits a new record. I mean, the step up from 2018, 2019 is just incredible. I used to have a Shopify store. I paid for their highest tier subscription. And even if you pay for their highest tier subscription, you still have to pay them 0.25% of every sale. So they basically collect royalties. And it's not just the revenue that's at a record, but the net income / profits as well. So hats off to Shopify. You know, profits are up 79% after they grew 102. So margin expansion here. So except that forward multiple is just tough. So Morningstar says they're reasonably valued, robust e-commerce gross merchandise volume expansion, strong merchant adoption, and growing enterprise adoption through Shopify Plus will continue to drive long-term valuable growth. You know, Mr. Beast has all of his websites and stuff on Shopify. Pretty cool. His videos are always sponsored by them. Hey, yeah, what's up? Hey, if y'all are enjoying, please leave a like. I'd greatly appreciate that. Thanks to everyone on the YouTube and TikTok stream. What app is that? Yeah, hey, this app I'm on, this is a brokerage where you actually buy stocks on. If you'd like to get this app, and you can analyze stocks on here and see what super investors do, it's in my link profile there. Or you can just type it into Google, brokerage called Moomoo, but I have an affiliate link in my profile where if you sign up and deposit $100, we'll both get a free stock. But you don't even have to deposit anything to use all the tools and analysis. So completely free, costs nothing. All right, let's see. Next up, Zoetis and Lowe's. Actually, let me do Lowe's, then we'll get to Zoetis, because Zoetis is struggling right now. But Lowe's, this is a pretty cool company. They're kind of real estate adjacent, like they move with a lot of the home builders, but and they're very interest rate sensitive because whenever um, interest rates are low, people spend more renovating and repairing their houses. But these companies always just have forced demand. Like people always got to restock their mulch in their yard and stuff. So Lowe's is really cheap on a forward PE. They traded 18 times next year's net income. That seems pretty fair. It's a dividend growth company as well. So if you buy a share of Lowe's right now, you get over 2.1% of your money back in a qualified dividend every year. And notice they raise their dividend every year faster than inflation. So every year you're getting paid more and more. 2% dividend yield, 18 forward PE. And here's their bottom line. Their printed net income, they had a slight one-time adjustment from an acquisition. Yeah, look at last quarter. They spent $10 billion buying a company, and so their net income was slightly adjusted from that. But anyway, incredible profits. They're usually making a couple billion in net income every quarter. So great dividend growth company to buy on the dip. Home Depot as well. So let's do Zoetis. This is an animal healthcare company, and they actually just lowered their guidance. They lowered their yearly EPS guidance by 10%, and the stock in response fell 40%. So I honestly think we are at a price where, yeah, the EPS is lower than expected, but the stock is falling way more than it should. So look at this forward multiple. It's an 11. That's cheaper than oil stocks. This is like a commodity multiple where they're not really expected to create or lose you any value. And that's because they're saying the growth story's gone. And I can kind of see where they're coming from. But I do think the stock is cheap. Check this out. If it load, yeah, look at the net income. The net income actually declined 0.1% year over year. So revenue or net income is down 0.1. I might have to reset my app for a second, or I might have to reset my app. I'm kind of lagging. I apologize here. Let me see if that fixes it. There we go. Okay, yeah, revenue only grew 2.9%. So this is like right around inflation growth rates, low single digit revenue growth, like 2.93, 0.54. So just low single digit revenue growth, and the net income slightly declined, which means the net margin fell by 3%, which is no big deal. I love what they do. They're in parasiticides, vaccines, dermatology, anti-infectants, pain and sedation, all for pets. It's like if you ever see a cow with like a white circle in its ear, that's a parasiticide to keep the parasites and the flies off. They're in horses too. So yeah, they have a 2.7% dividend yield, a 33% payout ratio. Very nice. So I do think the dividend's safe. They made $601 million in net income. I love deep diving into the numbers. If we go to the cash flow statement, you can see how much exactly the dividend cost every quarter. And the dividend cost $224 million. So as long as they're making over $224 million, they can easily afford the dividend. And look, even though the net income slightly declined, it's $600 million. That more than covers the dividend. So I'm not worried about the dividend. And actually, I bet the stock is going to do massive share buybacks. I might actually even look at it nibbling on some shares. So let's check out next. Bro, Cisco up. Let's check out Cisco, CSCO, right? So yeah, this is that software company. They're kind of back at their 2000s bubble level. Isn't that crazy? It was $82 and now it's $98 today. New all-time high. So yeah, if you've ever bought this stock, you're definitely up on your money. And check out the dividend. It's a nice dividend growth company. You don't really see this with a lot of software names. Like a pretty decent yield, a close to a 2% dividend with Cisco. And the valuation is a little high, a 30 forward PE. So what's cool is that if you look at any other software name like a Salesforce, Adobe, IBM or something, they are not at all-time highs. This is one of the few exceptions where the stock is at a crazy new all-time high when a lot of their competitors aren't. Cisco Systems to acquire Asterisk Security to expand identity defense capabilities. I love what they're doing because they just print net income. They're just doing acquisitions. Check out their after-tax net income at the bottom down here. They're easily making 2.8 to 3.2 billion of net income a quarter. And what are they doing with all this net income? Acquisitions. So one company I used to own a stock called Splunk, and then this company actually acquired Splunk. So that was in 2024. Check out how the annual revenue growth grew. It went from 2024 to 5 billion to 8.9 billion, or grew 60% year over year. So anyway, they're bringing the growth back through acquisitions, which I like. And it looks like they're doing another acquisition. Someone in chat said, I was wondering why you were calling me out. Someone's name is Cisco's. That's funny. Yeah, I'm talking about the stock here. So yeah, it has a pretty decent dividend of 1.67% dividend yield. Not too shabby, but it is expensive. I would not buy at all-time highs, but it's still one I like because of the dividend yield. All right, next up, why is everything down? Good question. I mean, yeah, look at the screen right here. Micron's down 8.9, Intel's down 9, Tesla's down 4. And look at my portfolio. RIP, like Comfort Systems, I'm down $800, 860 on Powell today. $100 on Amazon. So yeah, leave a like on the stream for me. It helped me out. By the way, if you wanted the follow button, I greatly appreciate that. I sell nothing. Just on here, give my opinion. Nothing's financial advice, of course. So yeah, watch out for people impersonating me. I'll never follow you, DM you. I again sell nothing. So Marcus said, "What do you think about Amazon?" I freaking love Amazon. It's a stock that I trust to never sell. So yeah, they're in this portfolio. They're in my buy and never sell account. So Amazon expands a 30-minute delivery service to dozens more US cities. Amazon launches health AI agent. Okay, cool. So yeah, Amazon is literally an ETF in one. And check out the first line here. Revenue beats estimates at $181 billion. Their AWS backlog surges 50%. And that's how the CEO defends the $200 billion spending plan. What's the AWS revenue? Well, where's the backlog revenue? Well, anyway, we're not going to deep dive into that. Amazon launches same-day delivery and kiosk service for Novo Nordisk Ozempic pill. So anyway, this is an e-commerce company. It's a grocery store. It's an AI play because they own 7% of OpenAI. They own 30% of Claude. And that's supposed to be like the biggest, that's the best AI model right now, Claude Code. So they own 30% of Claude. They're a huge e-commerce company and the best cloud company. This is the number one cloud business with AWS, number one market share, 30% plus market share. This business is over $130 billion a year. They're a robotics play. And if we go to the revenue, it just hits a record. They're the number one Fortune 100 company. They do $800 billion of annual revenue, and not just revenue hits a record, but the profits as well. So with the backlog, I love all the businesses that they're in, and they're spending a lot of money. $65 billion just this quarter. That's a lot more than they're making. So anyway, yeah. All right. What happens is, yeah, hey, again, yeah, thanks. Yeah, this app is called, it's a brokerage I'm on right here. It's called Moomoo. If you'd like to get this brokerage, it's actually in my link profile. I have an affiliate link if you want to sign up for it there. You can just type it into Google, brokerage called Moomoo. Let's see what's next here. But yeah, Amazon, it's hard to buy them here because they're at a kind of close to all-time high, and they're at a 31 forward PE. But I trust the future growth. I mean, Amazon out-innovates everyone. They're making their own chips now. Amazon's selling their TPUs like crazy, and that business is booming right now. I mean, is there any other news? Yeah. Anyway, yeah, subscription play, e-commerce play, advertising play, AI play, robotics play. I mean, cloud play, just ETF in one right there. Let's see what's next. Elf. Hey, what's up, Nicolo? Elf stock. Yeah, this is a beauty and cosmetics company. Dang, they have not been doing too well. And hey, we'll look at SoFi after this. What's up, Josh? What's up, everyone? Northern Jays, how's it going, man? Yeah, Amazon is such a great one. So Elf Beauty is actually surprisingly cheap. They're at an 18 forward PE. Currently, they traded a 31 PE, which means 31 times net income. But this is a growth company, so you value them off next year's net income. And when you do that, they're actually cheap at an 18 forward PE. So let's see how the revenue is growing. The revenue's up 38% year over year. Check that out. If we zoom out, that is a record revenue. I'm assuming it's from an acquisition, though. So here's how we can tell if this is organic or inorganic growth. You go to the cash from investing activities. Yeah. So they spent $600 million last quarter buying a company. And that's why the balance sheet, changed so dramatically out of nowhere. So they did this acquisition. So it's still 38% revenue growth. Very impressive. And on that, they made 39 mil in net income. And that's real. Before tax, it was 67 mil. After tax, it was 39 million. And let's see what analysts project. Oh, so next quarter, they're only supposed to do 6 mil in net income and then 55 mil in net income the quarter after, which will be the highest ever, or not ever, but highest in like over a year. So interesting. 18 forward PE and, the beauty and cosmetics sectors. Let's go to their website right here. Oh, that was kind of a cool intro there. Elf Beauty. Yeah, I want to see your actual products. Can I get, yeah, so it's just like makeup and stuff like that. Anyway, let's head out to the next company here. I know another one that's really cheap as well as Ulta Beauty. Ulta Beauty, they just gapped down on earnings and they only trade at a 17. So the same valuation, basically same growth. Both are valued pretty similarly in terms of growth. So Ulta Beauty trades at 18 times forward net income. Elf trades at 18 times forward net income. And check out the net income Ulta Beauty makes. That's crazy, a couple $100 million a quarter. So All right. Both stocks I approve of. I do like. Is it time to take profits? I'm not taking any profits, especially on a red day. I wouldn't want to. I would have taken profits on a green day if I wanted to take profits. But yeah, we are down pretty bad. We're down 3.5% in this portfolio. Our Robinhood account is down 0.65% at a new intraday low right now. And then our Webull portfolio is down pretty bad too at the top. We're down 2.7%. And all time, we're only up 21%. Yeah, if y'all wanted to follow button, I'm fully transparent. I share all my portfolios. If you got any specific questions for me, let me know. I go to a bunch of other streams and no one ever fully shares their whole entire portfolio and stuff. So here's SoFi, one of my favorite stocks to buy, growth companies. So SoFi's doing an acquisition. That's crazy. They haven't done that in a long time. Yeah, hey, we'll look at AMD and Micron after this. Try not to spam. We'll check them out. So yeah, thanks for being here. SoFi to acquire majority of British fintech primary bids assets. So in 2016, they rose 250 million. So I don't know how much they're paying, but SoFi Q1 crypto business generates 121 million of revenue with minimal net margin. Oh, wow. Okay, so that's not good. With a minimal net margin of only 850,000, resulting in net crypto revenue of only... The company has reported 239,000 crypto accounts. Anyway, let's go look at their actual numbers because even though their crypto business isn't generating profits, their financial services business is. If you're a shareholder of SoFi, the main metric you want to analyze and look at is their financial services business right here. Check out the growth rates in the middle. Revenue's up 42, after grew 101, after grew 85, after grew 195, after grew 290. So they're on a streak of growth where the revenue hits a new record every quarter. And check out the net income projections from the analyst. Analysts are expecting them to report 240 million of net income in 2 quarters. That's a record. Like, this is why I think people are starting to take SoFi seriously. This is a profitable, growthy business. They're making a couple hundred mil in net income a quarter, and it's supposed to hit a record 240 mil in 2 quarters. The revenue organically grew 42%. That's a record. Revenue's up 42%. That's what you want to see if you're going to buy and hold a growth company. And if we look at the valuation, all that growth at only a 22 forward PE, I think that is undervalued. They should trade higher than a 22 forward PE. So cool growth company. What app is this? Yeah, hey, what's up, XRIS? This is a brokerage we buy stocks on. They ask for a bunch of information because, when you make money, you got to pay taxes and stuff. But anyway, if you'd like to get this brokerage, it's actually in my my profile link there. I have an affiliate link. You can type it into Google, though. Brokerage called Moomoo. Yeah, if you want to use my affiliate link, it's in my link profile. If you deposit $100, we'll both get like a free stock. But it's free. You don't even have to deposit any money to just analyze stocks. So next up, I said I'd get to AMD and Micron. Let me do AMD first. And actually, let me do Micron. Because Micron, this is your memory shortage company. If you've looked at RAM prices, storage prices, SSD, hard drives, they are through the roof. I was just buying one on Amazon and I had to pay a lot more than what I paid a couple months ago. So basically, these companies genuinely have impressive future growth and it's being priced into the stock. And I actually think, they're actually down on the day because the administration plans supply chain to address memory chip shortage. So it looks like the government's stepping in to help actually fix the shortage. So this is it trades on the sentiment around the supply chain. If the supply chain fixes itself, then the stock will kind of trade off that negative sentiment and go down. But here's why Micron is actually undervalued, in my opinion. Despite this crazy chart where they look on a technical analysis overbought, here's why on a fundamental analysis, they're not expensive. Look at a forward PE of a 7.8. In English, that means they only trade at 7.8 times next year's net income. Here's the net income forecast from the analyst. Next quarter, they're supposed to do 22 billion in net income and then 25 billion in net income after that. Check out, this is a game-changing year. That's going to be a record net income. It's never even been close to 25 billion before. And it used to just be 1 to 3 bill a quarter. Now it's going to 25 billion, which is 100 billion a year annualized. And when the company's only worth 812 billion, that really is only a 8 times forward net income multiple. But again, it kind of just trades off the supply chain issues. I just feel like that forward multiple could stretch up to like a 20, or I don't know about a 20, but it's like an 8. It could go to a 12 or something before it maxes out. Pretty crazy. So let's see. How's it going? Hey, what's up, Larry? Good to see you. Check out Fly stock. Oh yeah, let me do AMD, then we'll do Fly. AMD is expensive, kind of like Intel. It's another shortage kind of play. This is off the CPU shortage. So Morgan Stanley forecasts server CPU market to reach 280 billion by 2030. Cites AMD as key beneficiary. AMD, look at the first line. AMD doubles server CPU market forecast over 120 billion, driven by agentic AI. AMD announces partnership with Meta to deploy 6 gigawatts of GPUs to them. Wow. So Meta is training their models on AMD chips. AMD CEO confirms sufficient memory supply secured for AI expansion. Warns rising memory costs may pressure PC and gaming demand. Actually, I believe it, because to buy a gaming computer now, it's really expensive. But anyway, yeah, a lot of the revenue comes from data centers. And check out the growth this quarter, 57%. Very impressive. And if we just go to the net income forecast, the net income in 2 quarters is supposed to hit 2.1 billion. So 2.12 billion in 2 quarters. It's never even been close to that before. So there really is a lot of future growth that's about to happen. If we zoom out, yeah, record net income was 1.5 billion last quarter, and it's supposed to go to 2.12 billion. So you really value them on a forward multiple, and check out how it's getting cut in half. Currently, they traded 142 times net income, but it's going to fall by the same time next year only to a 66. So it's having this year's 100% EPS growth rate. So yeah, there is a lot of future growth happening for AMD, and that's why I'm not selling my shares. So I'm up crazy on AMD. Check this out. We're up 250%, even though they're down 5.4% on the day. But I'm just going to hold on to my shares because there's still future growth that's happening. I still believe in the long-term thesis there. I might trim a little bit like I did trim one share, but I'm certainly not fully selling out of AMD. And I'm not buying any more shares here either. It is quite expensive, but I mean, they're having this crazy growth year. So someone said Firefly Aerospace. Yeah, what's up, Ben? Oh, a $6.3 billion company. That's actually a really big market cap. Firefly Aerospace subsidiary secures AFRL contract for advanced algorithm R&D. Huh. Is there any other news around this company? Firefly Aerospace selected by U.S. Space Force for Golden Dome space-based interceptor program, receiving $109 million contract reward. So they're helping out the Golden Dome, basically missile defense and drone defense. That's a popular industry. So pretty impressive stuff there. What are the future revenue growth forecast? Yeah, look at that. Whoa, revenue is going to go from 30 billion to 113 million year over year. So the revenue is just going to grow like 400% year over year. So dang. I'm assuming they're not profitable, so dang, they're still losing like 50 to 100 million of net income a quarter. And our forecasted is still, lose 75 mil, 83 million the next 2 quarters. But when the revenue is going to 4x in a year, it's okay for them to lose money. But we do eventually want to see them narrow those losses. And it's also really great to see them literally get this Space Force Golden Dome interceptor program, receives a 109 mil contract. Pretty cool. Expected to drive revenue growth, with the company forecasting 2026 revenue between 420 and 450 million. So look at that, 450 million of annual revenue. Check out what it was before today. Let's go to annual 2025. It was 152 mil or 159 mil, and it's going to go to 450 mil for full year 2026. That's the growth story there. Kind of cool. Next up, hey, what's up, Logan and FNS? Good to see you all. Hope everyone's having a great Tuesday. I know the market's a little red, but wouldn't be worried. So let's do next ARHS, and then we'll do Home Depot and then ServiceNow. I always mix up the order, so I apologize if I'm behind and missing out on some of y'all's stocks. Hey, what's up, big mans? Yeah, we'll look at Oracle and Meta and Rocket Lab. Yeah, I want to get to all these stocks. Don't worry. We're going to be streaming for another hour at least. So yeah, if y'all want to hit the follow button, like button, I greatly appreciate that. I saw nothing. I have no course book. Just undergive my opinion. So yeah, I would be careful with this one simply because they're really tiny. If you look in the top right, the market cap, they're only worth 850 million, and they're close to an all-time low. So when the market cap is so tiny, like 850 million, just hard to trust a lot of money in them. And the growth really slowed down this quarter. Revenue only grew 0.9. So when the revenue, the lifeblood of the company, the sales only grows 0.9, that doesn't beat inflation. And so the revenue grew 0.9, the profits fell 59%, which means margin declined. Only a 0.7% net margin. Gross margins declined. What do they do? Let's actually find out what this company does. Let's go to their website. 20% purchases off over $2,000. Oh, is it like a furniture company? Bro, no. Okay. So some sort of like I don't know, home, yeah, living, dining room, bedroom, bath stuff, cabinets. So some sort of like home part decoration stock. Kind of a low margin in a tough industry right now. So someone actually said Home Depot. Yeah, Logan, let's do Home Depot. This is probably the better one to buy. If I was going to buy like a home improvement kind of company, Home Depot might be the best, one of the best companies out there, because you get everything in Lowe's, like the mulch, your lights, your fans, whatever. These do better under a lower interest rate environment. Whenever rates are high, people don't spend as much repairing and upgrading their houses, but that will happen uh, when we get into a lower rate environment. But yeah, look at this valuation. The forward PE is a 21. So they only trade at 21 times next year's net income. And I think it's because of the high rates. It's really slowed down the growth here. So we're going to go check out the growth. I'm pretty sure the growth has been slightly negative even. So let's pull that up. And that's why the valuation is kind of low. Yeah, look at the revenue year over year. So the revenue declined 3.8%. So revenue's down 3%. Profits are down by 14%. So their net margin fell as well, but they still print money like easily every quarter. They're making like 3 to 4 billion in net income every quarter. And you get a nice dividend. It's a dividend growth stock. If you buy Home Depot right now, you get 3% of your money back just in a qualified dividend every year. So yeah, pretty cool. So next up, let's do ServiceNow. This is a cool software company, and they acquired Armis, which is a cybersecurity company. But check out this future 2030 forecast. They're projecting 32 billion in revenue by 2030. If you're wondering what's the annual revenue currently, well, check this out. This is why I'm a fan of this stock right here. The full year 2025 revenue was 13 billion. So it's going to more than double in just 5 years. So the revenue is going to CAGR at like a 30% clip through 2030. That's why I think this is justified to have a high multiple, because here's the one bad news. They're expensive. If we look at a forward PE, they're still trading at a 41 forward PE, which means 41 times next year's net income. That's still pricey. Like it could still fall. I feel like it could stretch down to like a 37, 35 forward PE before it bottoms. So that being said, this isn't the time to go all in, but it's a decent time to nibble, because that future growth expectation is actually pretty interesting. There's a lot of bullish news around this company, partnerships and stuff like that, acquisitions. But yeah, ServiceNow, 41 forward PE. It's the time to nibble, but not go crazy yet. But yeah, the revenue forecast is really bullish, and they're already super net income positive. Like they're already making 400 or 500 million net income a quarter. Pretty cool. All right. Next up, Ben, Headstat Fundamentals tab. I don't have it. Oh yeah, they changed the name of it. All right, next up here, would appreciate it if you check out Siltronic. Hey, Mo, if you give me the ticker symbol, yeah, if you have a stock you may look at, please give me the ticker symbol. Like Rocket Lab is RKLB. We'll check it out because I've not heard of that one before. So here's Rocket Lab right here. So Rocket Lab reports revenue of 200 mil, up 63% year over year, beating expectations. Is there any other news? Rocket Lab to acquire Motive Space Systems for 60 million, rebranding as Rocket Lab Robotics. Wow, that's cool, an acquisition. Rocket Lab and Raytheon selected for U.S. Space Force-based interceptor program demonstration. That's pretty cool. So you have that Golden Dome protecting us and other countries from missiles and drones and stuff. Rocket Lab signs largest launch contract with 5 Neutron and 3 Electron launches. Secures 30 million hypersonic contract. Anyway, it seems like they're just getting a ton of deals right now. And they're doing acquisitions. Unfortunately, they're really expensive, but they're expensive for a reason. Check out the revenue growth. That's what you want to see when the revenue just hits a new record every quarter. So revenue is up 63% year over year to 200 mil. But bad news, they're still losing around 50 million. Yeah, 50 to 60 million of net income a quarter. But it's okay when they lose money like this, as long as they keep up the growth. And the analysts are forecasting the growth to continue. Revenue is going to go from 155 to 233 million year over year. So there's still a lot of growth. So yeah, they're in space systems. That business grew 57, after grew 45, after grew 30. So incredible growth on that business. And their launch services grew 78%. Last quarter grew 79 and 95, 58. So just unprecedented growth. That's why the stock has gone up so much. But would I buy it at all-time highs? Definitely not. There is no forward PE because they're not expected to make any money anytime soon. But I like the revenue growth. And that's a good balance sheet. I think they're using really shares to do this. Yeah, they're diluting the life out of the shareholder, but it's really the smart thing to do when the stock's overvalued. What app are you using? Yeah, hey, Cole, what's up? This is a brokerage where you buy stocks on. If you'd like to get this brokerage, it's actually in my link profile there, brokerage called Moomoo. You can just type it into Google, though, but if you want to use my affiliate link, it's on my link profile there, broker called Moomoo. Completely free, costs nothing. Next up, we got XNDU. All right, XNDU. Then we'll look at SMR after this. Yeah, SMR is a tough one. I actually would not buy that stock, but we'll check it out after this. I'll give you my reasoning behind why I wouldn't buy one stock. So this is Xanadu Quantum Technologies. I know the quantum industry has been just on fire. This is actually a Canadian company, so let's convert the currency to US dollars just to kind of understand it a little better. So they're not doing much revenue. The revenue was 1.3 million. So they're basically getting their first ever sort of revenue. So they made 1.3 million revenue and they lost 16 million on that. So yeah, headquartered in Ontario, Canada. Provision of quantum computing solutions for enterprise and government customers. Quantum computing, it's basically just making computers go faster, go quantum speed. Like, I really think the industry leader is going to be Google and Microsoft because they already are. I've already seen what Google's quantum stuff is. Like, Google's already the leader. I'd be careful with some of these startups, like only 1 mil of revenue, losing net income every quarter. And the market cap is 4.2 billion. That is double the market cap of Dave and some of these other companies that have way better fundamentals. So I would be real careful with that one. Here's another stock, sadly, and I don't mean to be bearish. I just like showing you the numbers for yourself and you can draw your own conclusion. But here's why I would not buy SMR. This is SMR NuScale Power. They're supposed to be a small modular reactor nuclear company, basically making small nuclear reactors. But this is a startup right here. They are not going to have any sort of revenue really till 2030. They were selling off some assets, but I mean, look at the revenue. I mean, it's just hard to trust this company. The revenue was 500,000 this quarter. 1.8 million. And the reason they had revenue back here is because they were actively selling out of their assets. This isn't like revenue they got from a working nuclear reactor or something. No. So unfortunately, the revenue is just nothing and they lose a lot of money. 50 mil, 60 mil, 500 mil, 40 mil, all for declining revenue. So it's really a big future story you're buying into. So if you're wanting a real nuclear company, like with real nuclear assets, the stock I would go with is actually CEG, Constellation Energy. And they're also on a dip. Look, they're down 10% on the week. So you can, if you like buying stuff that's technically under or oversold, then check out CEG. This company owns 33% of all the US's active nuclear reactors. It's the purest play for nuclear energy. There is no close second. So that's what I love about CEG, well over NuScale, because there is no forward PE on this company. They have no revenue. Let's see the revenue forecast here. What are the analysts forecasting for revenue next quarter? Revenue's supposed to be 13 million and 14 million, but look at how they miss like crazy. Like analysts expected 5.5 mil this quarter. They did 500,000. So they're missing on earnings like crazy, and that's why they're gapping down on earnings. Nokia, hey, Nokia, I think that's an NVIDIA company. Hey, what's up, C Money and Rids? Then we'll look at Amphenol. Definitely we'll look at Amphenol after this. One of my favorite stocks to buy on the market, but an NVIDIA holding, so meaning NVIDIA actually owns shares of this stock. NVIDIA actually has a stake in Intel, CoreWeave, Synopsys, but yeah, then there's Nokia. Kind of interesting there. Yeah, let's check out Nokia. They've really converted, when you think of Nokia, you think of the phones, they lost the smartphone war. Apple won the smartphone war. So here was the stock in the year 2000. It was a $55 stock, and now it's a $12 stock. But notice the rally they've had over this last year specifically, because they've converted from a smartphone company to like a software company. A little bit of a cloud company as well. And where's the net income? Okay, here it is. Yeah, look at the net income forecast. I'm actually impressed because they really do make a couple $100 million net income a quarter. So it's not like some money losing company. Like they really do make good net income. Next quarter, they're supposed to make 260 million, 395 mil of net income after that. So they do have some impressive net income projections. So yeah, the forward PE is at 38, which is still expensive, but look at how it's cut from its current 72 PE. It's falling all the way down to a 40. So they're having this year's like 50, 60% EPS growth, but a 40 forward PE is still too expensive. I think that one of the reasons they've been rallying is because of the NVIDIA investment. So Morningstar says they're overvalued, actually. Structural headwinds from mobile equipment commoditization and intense pricing pressure from CapEx-wary telecom carriers require caution. So there we go. Yeah, I do agree that they are overvalued. I wouldn't be adding shares at today's price, but they're interesting. Let me get my water here. So yeah. Yeah, Oklo, QBTS. I wouldn't really buy either of these either. Like these are day trading companies, something you want to swing trade. You don't buy and hold these for the long run because they are ridiculously overvalued. But what are the revenue forecast here? So if we just go to the revenue right now, I mean the revenue is a couple mil a quarter, 2 million, 3 million, 3 million, and the whole entire company is worth $8 billion. There is no forward PE because they lose net income every quarter. So that's the tough part. Dang, they lost 42 mil, 140 mil, 167 mil. So they're losing a lot of net income, very low revenue. But look at the revenue forecast. I mean, I guess it's going to hit 13 million in 2 quarters, but that does not justify an $8 billion market cap, in my opinion. So long term, I am definitely bearish on this one, but they could still do good. I mean, the momentum on quantums right now is on fire. But yeah, the way I value a stock, this one is overvalued in terms of the market cap. It's one I would kind of stay away from. So let's look at Amphenol. This is a really great growth company. They sell the copper cables and interconnect systems to NVIDIA and Google. Google TPUs use Amphenol, and also NVIDIA's NVLink spine. And the NVLink spine uses over 2 miles of copper cables, and that's mainly provided by Amphenol. So what I'm a big fan of is this valuation. Again, this is a growth company. You value them off next year's net income, and they're only at a 23 forward PE. That is a cheaper valuation than the S&P 500. And here's why I think that this is definitely undervalued, because they have incredible growth. If we go to their main communication solutions business, check out the growth rate in the middle. It's up 87% year over year. After grew 90, after grew 12. So they're on a streak of growth, like these year over year growth rates the past 5 quarters in a row. And not just the communication solutions, but also their harsh environment solutions, which is underwater subsea cables and also aerospace and defense. That's up 33%. After grew 39, after grew 7, so that's on a nice streak. In their interconnect sensors, that's up 25 after 5% growth. So incredible growth. So when we combine all those businesses together, the revenue grew 58%. So the revenue grew 58 and the profits grew 82. They're the most profitable they've ever been. This specifically was the most profitable quarter, and it was a record revenue quarter. So I have no complaints around this company. They just acquired CommScope, which is instantly accretive to their EPS. So yeah, it's a cool AI infrastructure play. Instead of just buying NVIDIA, which sells the chips, buy some of the other layers. Buy the company supplying the copper cables to them. Buy the company doing the HVAC work, like Comfort Systems. Buy the companies doing the complex MEP work, which is the mechanical, electrical work, plumbing work for these data centers, like Powell Industries. And you can buy the companies as well supplying the nuclear energy, like Constellation Energy, which owns 33% of all the U.S.'s active nuclear reactors, largest fleet, purest play. So anyway, yeah, I'm a big fan of just the whole ecosystem of AI. So next up, WAF, yeah, and then we'll check out some of these other ones. IPO Cerebras, is it? I don't know. I gotta check out the earnings. So someone said WAF, please let me know. Is this a stock right here? West African Resources, this like Australian listed company. I can't find WAF, or maybe it's WAFD. Let me know. So, hey, what's up? Daryl said grab. This is a really cool company. I think you'll find it interesting. And yeah, we'll look at Casey after this. And Credo, MongoDB. We'll try and get to all these. Yeah, try not to spam there. But here's Grab right here. If you're wondering what is Grab, what do? They do exactly what Uber does, but internationally. So they do ride sharing and food delivery, but in these countries, Malaysia, Singapore, Indonesia, Philippines, Thailand, Vietnam. So notice the US and Canada and the UK aren't on here. That's what I like about this one, is that they're a pure international play. And what's so cool is they're backed by Uber. Uber is the largest shareholder. Uber owns 13% of all the company. Toyota Motor owns 5.5% of all the shares. So they have backed by some great investors. And I think it was genius for Uber to buy this stock, because Uber's having trouble internationally expanding into these markets. So they're like, hey, why not just buy the biggest player, which is Grab? Just Malaysia does $1 billion in revenue for them a year. Singapore does 720 mil. And this is a universally needed commodity, ride sharing. The forecasts of the net income are great. Like they're profitable as well. They just got net income positive. If we zoom out, it used to be a tough buy a year ago. They were losing 100 mil a quarter. But now it's like this, I can wrap my head around this. They're actually making great profits. So anyway, they're still slightly expensive on a forward PE, but it's justified, I think. I also love just Uber stock. Uber only trades at 20 times net income. Uber is actually one of my most recent purchases. I bought them 2 weeks ago for the first time ever, and they're at a 20 forward PE. Yeah, and Uber's the largest shareholder of Grab. All right, next up, I'm worried about Micron going down. I mean, I don't own any Micron, but not really, because the forward PE is so cheap on them. So, all right, what did I want to look at now? Oh yeah, Credo, what's up? Your auntie said CRDO. This is another AI infrastructure play. They're down 12% on the day. Is there any specific news? Or I don't know. Anyway, let's go look at the fundamentals, because this is one of my favorite growth stocks. Like, I promise you will be impressed with the growth that they have. This is why the stock is at an all-time high. They're not at an all-time high because of momentum. They're at an all-time high because the fundamentals keep on beating expectations. Check out the revenue growth rate at the bottom. Revenue grows triple digits for the past 5 quarters in a row. So revenue's up 201% year over year. And this is organic. Like, they didn't acquire a company to get this revenue growth. This is just genuine organic revenue growth. So 407 mil of revenue, and on this 407 mil of revenue, they had the most profitable quarter ever, 157 million of net income. So no wonder this stock is at an all-time high. The profits are at an all-time high, the revenue growth is, and they have a fortress balance sheet. This is a debt-free monster. I mean, they have no debt, 1.3 billion of cash. The cash pile just grows every quarter because, they don't owe anyone any money. So when they make 140 mil of free cash flow and 157 mil of net income, they just keep it and retain it all. And they're beating net income expectations from analysts. Analysts expected 128. They did 158. And it's still supposed to have 100% EPS growth. Net income's going from 63 to 155. And that doesn't assume they beat on earnings. So really impressive stuff here. Dang, yeah, 57 or 47 forward PE, but look how it's getting cut in half from its current trailing 12 months PE of 100. Impressive stuff. I love that company. They're actually similar to Amphenol. All right. Inflation hot again. Most stocks are going down. Oh yeah, did we have an inflation report this morning? CASY. So Casey's General Stores. Yeah, these boring like grocery stores have been doing amazing. Like, you look at Walmart, Costco, these stocks are doing pretty good. And here's Casey's General Stores. Like, I'm shocked at how this is like an NVIDIA type move here. Beautiful move up. But what's crazy is like the fundamentals don't really align with the stock price going up. Like, the revenue growth just like went away. Revenue's only up 0.3% year over year, which doesn't beat inflation. But the margins are crazy. So the revenue only grew 0.3, but the net income grew by 50. And that's real as well on operating profit and net income. So the net margin actually expanded 50%. That's why I think this stock is doing so well. It's actually because of margin expansion. So, yeah. Because historically, grocery stores are a very low margin industry, but I think they're like expanding margins. I wish I could give you more thoughts on this company. But yeah, 43 forward PE is really expensive. But if we look at Walmart, Walmart's at a 45 forward PE. So maybe it's just the industry norm. I like Amazon. I got Amazon. Amazon owns Whole Foods. And what's cool is Amazon actually delivers it to you. That's why Amazon beats out like Sprouts Farmers Market and stuff, because Amazon has that online presence where they'll deliver their groceries to you. So yeah, pretty cool. Next up, let's see. Do you think if hyperscalers were to have news that they're slowing down and spending on AI infrastructure, would APH fall heavy? It probably would fall with the momentum, but yeah, if capex slows, in theory, it should. That would be bad. You saw Intel, yeah, Intel was going crazy. Um, MDB, oh yeah, here was some other software company, MongoDB. Let's check out this one right here. Unfortunately, the stock has not done too well. It's the same price that it was in 2020. So this stock has been flat for 6 years. So for 6 years, this stock has done nothing. But look at what the revenue has done over 6 years' time. This is the crazy part. 6 years ago, the revenue was 100 to 130 mil a quarter. Now they're like revenue hits a new record every quarter. Revenues, and this is in US dollars, basically 700 million of net income or revenue, of revenue this quarter. And they are barely getting net income positive. So look at this. They are basically just now making their first ever sort of money. So you're buying this company as they're converting from a business that lose money every quarter, potentially to making money every quarter. Because yeah, technically this company has never made any profits ever. All they've done is lose money. That might be why the stock has been flat for 6 years. Maybe it's taken them way longer than they originally thought to get profitable. But looks like this next year is going to be the first year where they actually make profits. Luckily, they have a fortress balance sheet. They actually have no debt, so or no net debt, 2.4 billion of cash. So actually, I like this one, but I bet they're still expensive because they're just now getting net income positive. So yeah, if we go to a forward PE, so actually analysts aren't even forecasting positive net income. Yeah, they're supposed to lose 30 million next quarter and lose 28 million the quarter after. So that's what you're just watching on that company, just the net income, because the revenue is phenomenal. It hits a record every quarter, but not the profits. Unfortunate. So let's see. Should I sell Intel? Intel lost me so much today. Dang, Jacob. Yeah, try not to, put all your eggs in one basket. Intel hit an all-time high the day before pretty much. So yeah, depending on where you bought in. But yeah, 10% down day. Honestly, you could kind of see it coming just from a technical. It kind of needed a healthy RSI retrace. But yeah, it's always not great to see a stock fall 10%. Intel and NVIDIA expand $5 billion partnership. NVIDIA bought a big stake into Intel. If we go to the NVIDIA portfolio right here, their largest holding is actually Intel. It's 72% of their portfolio, and they're up crazy on their investment. Same with the US government. They're up over 6x on their original investment. And here was the day NVIDIA actually took their investment. Actually, this was the government day. Never mind. It was a little after NVIDIA took a stake. But yeah, crazy. It's still really expensive, 185 forward PE. But yeah, the government took a stake in companies like Apple and NVIDIA as part of a way to agree to spend a couple $100 billion on the US and the tariff exemptions. One way they can spend a couple $100 billion on US or, give money to the US economy is by moving some of their manufacturing to Intel. And that's what NVIDIA is doing. They're moving some of their manufacturing to Intel, and Apple is moving some of their chips manufacturing back to Intel instead of just Taiwan Semiconductor. So pretty cool stuff there. What do you think about HIMS fundamentals? Can still swing? HIMS is a tough one because the profits are really low. HIMS Q1 revenue. Oh, they're down 15% on the day. Reports 2026 Q1 loss of 92 million. Raises full year revenue guidance while cutting EBITDA. Hims and Hers reports 8% domestic sales decline, offset by a tenfold international sales growth. So international sales were up tenfold. I do wonder if that was from their eucalyptus acquisition. Hims and Hers earnings missed with 92 million amid strategic shift to branded GLP-1 medication. So yeah, basically Amazon's kind of eating their lunch. Everything you can get on Hims, you can now get on Amazon as of 2 weeks ago. Ozempic pills, Wegovy pills, and injections, they're all on Amazon. So actually, dang, the Morningstar research is bearish as well. So Morningstar says they're overvalued. Aggressive market optimism surrounding its compounding weight loss offerings masks significant margin pressures from international expansion and looming legal and regulatory risks in the GLP-1 markets. Dang, look at that net income projection. So analysts were projecting them to make 10 million, and they actually lost 92 million. And they missed on revenue too slightly. They expected 616, they only did 608. But there is future revenue growth, but look at this. Revenue is going to jump a very nice amount to 766 mil, but the net income is actually going to fall. So their most profitable things were used to be selling these weight loss prescriptions, but now they sell it for basically no margin anymore. That's how they used to make a bunch of net income, but then they stopped selling it, got into some legal trouble, started selling a knockoff, stopped selling the knockoff, then started selling back again Ozempic and Wegovy, so for a much lower price. So anyway, yeah, revenue growth of only 3.77%, not great. It wasn't a good quarter, I will say that. I mean, the tenfold international growth was good, but check this out. Oh, here's a recap. Okay, pretty cool we get this. Subscriber growth reached 2.6 million, driving 4% revenue growth, but US revenue fell 8% due to changes in weight loss product shipping. International revenue surged 969% to 78 million following acquisitions. Yeah, that's what I thought. The eucalyptus acquisition. So that significantly boosted the revenue, but the actual profits are not following. So that means margin decline. So yeah, profitability declined sharply with a net loss of 92 million, impacted by 33 million restructuring charges and 15 million legal settlements, contracting gross margin. Anyway, yeah, so, there is no forward PE now. Before today, there was a 65 forward PE, but look, they're expected to lose 34 mil and only make 50 mil. So now there is no forward PE. That's tough. Anyway, I'd be real careful. I do like Eli Lilly more. I'd rather be the companies selling and owning the weight loss prescriptions, the patents and stuff. And Zepbound is the main weight loss prescription winner. And Eli Lilly, even though the stock has done amazing, they're still not a super expensive at a 29 forward PE. I think that's very justified for the growth that they have. Morningstar says they're fairly valued, but yeah, they have so many prescriptions that grow so fast, like organic revenue, not including acquisitions, like revenue's up 55% to 19 billion. Like the law of large numbers isn't hurting this company. Like this is incredible revenue growth. And revenue's up 55, profits are up 85, which means margin expansion, most profitable quarter ever, basically 10 bill of profits of net income. It's ridiculous. Yeah, 35 to 40% net margins they're selling their prescriptions at. It's pretty impressive. Unrelated to AI, opinions on Nike and Netflix. Yeah, let's do Netflix. I love Netflix. What app is this? Yeah, hey, by the way, I'm on a brokerage right here where you buy stocks on and analyze stocks. It's free. If you'd like to sign up for it, I actually have a link in my profile there. It's an affiliate link. But you can just type it into Google, brokerage called Moomoo. Yeah, if you'd like to get this app, our brokerage, I have a link in my link profile there. So next up, we got Netflix, and then, hey, Happy, he says, I've watched your live for 100 minutes. Yo, are you serious? I'm going to give you a follow. Thanks for that. I really appreciate you. So here's Netflix. This is a cool subscription model company. A lot of people pay, for Netflix, and recently they just rose prices. They rose Netflix prices, and I don't know about y'all, but I'm not canceling my Netflix subscription. They really do have pricing power. So Texas attorney sues Netflix over alleged illegal data collection. Netflix and Amazon Prime subscribers were required to pay TV license fees. I don't know what all that's about, but Warner Bros. Discovery pays $2.8 billion termination fee to Netflix. So that's actually one thing that helped out the earnings this quarter. Because they weren't able to acquire Warner Bros. Discovery, they got for free a $2.8 billion payment. So that kind of artificially made their net income this high. Because if we zoom out, it's like a crazy net income quarter. They didn't actually make that. It was artificially up by 2.6 billion. But even still, it was a really good number. It's a really easy business model to understand. You just pay for their subscription. They have 301 million premium subscribers, and they make an average ARPU, which is average monthly revenue per paying membership, $11.69 per month per user. And Netflix valuation is pretty fair. They're at a 26 forward PE, so they only trade at 26 times next year's net income. So if you pay for Netflix subscription every month, why not also own the stock as well? Historically, it's done pretty good. I know they're kind of being boycotted right now, and they did just lose 2% market share. That was one of the reasons they fell on earnings. They're raising prices while losing 2% market share. It's not exactly a great look. A YouTube TV is actually took 1% market share from them, which is pretty cool. Or if you like Google and YouTube stock, YouTube on the TV is actually like really popular, more streaming hours than Netflix does on TVs. Yes, I'm learning from you. I want to buy my first stock. I'm driving, so I can't hit the likes. Hey, no, definitely don't text to drive. But hey, thanks for watching. I appreciate you. Yeah, if you're looking to get into a first stock, Netflix would be a good one. I'm always a fan of don't buy anything risky, some small cap, micro cap money losing company, buy companies you know, love, and use. If you like Google and YouTube, buy Google stock. If you like McDonald's, buy McDonald's stock because they're a really cool real estate and royalty company with one of the most valuable real estate portfolios in the world, top 5. Meta, if you like Facebook, Instagram, and Threads, buy Meta. If you pay for Amazon subscription and if you always buy a bunch of Amazon stuff, buy Amazon stock. Invest in what you use. If you like Coca-Cola, buy Coca-Cola. And there's so many great companies like Home Depot. But S&P 500 companies. Do you think SanDisk is going to hit a new all-time high? Yeah, SanDisk I do think will hit a new all-time high in the future. I don't know when, but yeah, they've actually are up 3,360% in a year, which is better than NVIDIA's whole 5-year rally. So anyway, SanDisk, this is your memory shortage company. If you're wondering why is the stock gone up so much, well, it's pricing in the future net income growth. Next quarter, they're going to do $5.2 billion net income and then $6 billion of net income the quarter after. That annualized is $25 billion net income, and the company is worth $203 billion, which actually means they only trade at 8.3 times next year's net income. That's where it actually starts to look like it can go higher. This forward PE of an 8 can stretch up to like a 12, I think, pretty easily. But that being said, I don't know if I'd buy it after it's already gone up so much. But if I was a shareholder, I actually wouldn't be selling on this dip. One reason why SanDisk is falling on the day is because the administration came out and they said they're doing things to help fix the supply chain. So yeah, SanDisk, Micron, they kind of trade off the sentiment around the supply chain. Oh, here's Michael Burry. Look at that bearish thing in the middle. Michael Burry warns SanDisk 3,900% surge exceeds dot-com bubble peak. Raises valuation concerns. That's the thing. It's hard to be bearish. It really is. When the forward PE is at 8.6, so they only trade at 8.6 times next year's net income, and here are the actual net income projection numbers from the analyst. 5.2 billion, 6 billion the quarter after, so just crazy growth. And same with Micron. Even though Micron, which almost identical looking charts here, both down 10% on the day, even though Micron is up crazy, they're only at a forward PE of a 7.7, which could stretch up to like a 10 or a 12 before it maxes out, send that up another 40%. Pretty ridiculous. Okay, let's see. Is it worth buying? Is it worth it to buy NVIDIA and Apple? Definitely. Those are two of the best stocks out there in the market. A lot of people think like NVIDIA's pretty much at an all-time high right now. Is there any room for it to continue to climb higher? Here's why I think so. And a fun statistic is whenever a stock hits an all-time high, statistically, it's followed by a cluster of new all-time highs. That also is the same in the opposite direction. When a stock hits a new 52-week low, it statistically is followed by a cluster of new 52-week lows. But look at this. NVIDIA on a forward multiple, and that's how I like to value stocks, like or specifically growth companies, you value them off next year's net income, not trailing 12 months net income. Look at how much the forward PE falls to. It is currently at 44. NVIDIA only trades at 25 times next year's net income. NVIDIA has one of the most impressive net income projections. I mean, look at this. They're still going to have 100% EPS growth. Net income's going from $26 billion to $46 billion year over year. They're legit like collecting royalties. They have a 63% net margin. So if you go buy NVIDIA RTX 3080, you're spending or whatever, you buy a chip for $100, scale wise, you spend $100 on one of their chips, they keep $63 after taxes. So they did $68 billion of revenue and they kept $43 billion after paying, $5-6 billion of taxes on that. So I'm just really impressed, and the net income growth isn't going to stop according to the analyst. And that's why I think they deserve a higher multiple than a 25. It could still climb higher. That being said, it's not the best buy because if you look in the market cap, it's a $5.25 trillion company. It's the largest company in the world. If you buy a share right now, for you to double your money, they have to be worth $10.5 trillion. So just from a law of large numbers, it's a tough double. But I still think if you buy NVIDIA shares right now, you'll still get S&P 500 type returns, 8 to 10% of your money back, simply because the forward PE is a 26. Big GPU market share, 24% GPU market share. NVIDIA, or Morningstar says NVIDIA is undervalued. Unmatched dominance in GPUs, pretty much the picks and shovels play for all these data centers. They sell their graphics cards. High switching cost rooted in the CUDA software and exponential data center spending will drive long-term value growth. Yeah, people are spending crazy money on data centers. Oh, there was this other report, CoreWeave, their customers, 99% of what the customers are asking for is or if the orders are NVIDIA chips. So Well, NVIDIA owns a bunch of core. If you know, NVIDIA is so big, speaking of NVIDIA, they own some stakes in companies. NVIDIA took a big stake into Intel, into CoreWeave, Synopsys, Nokia, Nebius. So NVIDIA is like a pretty cool company. What happened with earnings for CEG? What's up, Nicolo? CEG earnings were great. So this is another great AI infrastructure company. This is the stock that owns the most nuclear reactors. So Constellation Energy literally owns 33% of all the US's active nuclear reactors. No close second. This is the best one. And they had phenomenal earnings this quarter. And the valuation is cheap. They only trade at 25 PE. And a 23 forward PE, so only 23 times next year's net income. And check out what the analysts expected. 8.7 bill of revenue, they did 11 bill. They expected 900 mil in net income, they did 1.5 bill in net income. And that was real. Look at the EBIT. This wasn't some one-time gap adjustment. The earnings before interest and taxes was 2.3, and analysts expected 1.3. Now, part of this was because of an acquisition that they did. So basically, and this isn't even the full amount, but they just bought Calpine. It was an acquisition. They bought them for over $15 billion. So next quarter is when it'll really load in. But that's one of the reasons why the revenue beat so crazily. It went from 8.7 to 11.1. It was the Calpine acquisition. But this Calpine acquisition is accretive to their EPS and the free cash flow. So anyway, I'm a super big fan of this one. They're the number one nuclear play, the number one geothermal energy play, which means they take this hot steam, these geysers. They have a property called the Geysers. It's in California. This one property in California it's a huge facility that just like hot steam comes out of the ground. It supplies 10% of all of California's clean energy, just that one site. So anyway, they're the number one geothermal play. Pretty cool company. App name, yeah, hey, what's up, Jello? Hey, we'll look at that one too. Yeah, if you'd like to get this app I'm on, this is a brokerage where you buy and analyze stocks on. It's completely free. It's actually linked in my profile. If you'd like to use my affiliate link, you can just type it into Google, though, brokerage called Moomoo. Yeah, it's in the link in my bio there. And if you end up depositing $100, we'll both get a free stock, but you don't even have to deposit $100. It's completely free. There's no way to pay money. There's no subscription. You get a 3.35% APY on your idle cash for free. You can see what all the super investors are doing. Pretty cool app. Actually, I have all these apps linked up there too. I have Robinhood as well. They're all brokerages. You know, they all ask for a bunch of information because whenever you make money in stocks, you got to pay taxes and stuff. So I have all those brokerages linked up there. But my favorite brokerage and the one I'd recommend the most, which costs the least, is the most useful, the best one, in my opinion, is Moomoo. Very first link in my link tree there, or very first link in my bio. Or profile bio there. Anyway, you can just type it into Google though. Let's see. Next up, we got ARM. Hey, what's up? Wait, Jello had a name there. Let's shout out the. Have you checked MRAM? Let's check out MRAM. I think it's that ETF right there. No, it's actually not. This is Everspin Technologies. I'm assuming this is some memory shortage company, just like a Micron and a SanDisk, because they're down 10% on the day, and the charts have a very similar, like 1 month performance here. Is there any comments in here, or any news? I mean. Did they like IPO kind of recently? I don't know. But let's check out the future projections here. Yeah. So this one is out of all the memory shortage stocks to buy. I don't know if I'd buy this one. Oh yeah, because look at the market cap. In the top right, they're only worth $840 million. So it's just a hard one to trust. $840 million company when the revenue is $14 million, but it's going to grow to $18 million, and they're actually going to make $450,000 of profits. So that's the cool thing. Out of all the companies out there that are worth $800 million, you know, I want to buy the one that loses no money. You know, they're basically losing no money. They lost $200K and $200K. So they break even every quarter because they're going to make net income. And with this memory shortage kind of thesis here, that one might help out the stock because I'm assuming they sell memory shortage hard drives, SSDs, stuff like that, given how similar their chart looks to the other names. Pretty cool. All right, let's see. I'm so behind on the chat here. I do apologize if I'm missing some. Yeah, hey, Chill Trader. Yeah, it's in the description. What's up, man? I appreciate you. First link in the description. The Vigilante said, how about Target? Let's do Target. And Nebius, what's up, Flacinto? Good to see you, man. And then we'll look at Corning. What's up, Take Profits? Yeah, Corning is an incredible infrastructure stock. So here's Target right here. They've kind of been out-innovated. You know, anything you can get on Target, you can basically get on Amazon. And, you know, Target really lacks that online presence. And they're actually less of a grocery store. So grocery stores are more recession resilient. You know, people always got to buy toiletries and staples and stuff, even in a recession. But Target sells more discretionary stuff like household essentials, hard lines, apparel, accessories, home furniture, beauty products, some more discretionary items than like a Walmart. And that's why I think they're being hurt more than a Walmart. Walmart's at an all-time high right now, when Target is like 50% off its all-time highs, and the growth kind of just went away. Look at the revenue, the lifeblood of the company, the sales. Look at the growth rate at the bottom. Their sales have actually declined for the past 5 quarters in a row. It's negative growth. So sales are declining and margins are declining as well. So revenue fell by 1.5, revenue's down by 1.5, profits are down by 5.3, which means the margins are actually contracting as well. Net margin fell 4%, fell 18, fell 20. So that's why I think Target is struggling right now. And they also pay a dividend, though. It's kind of like a dividend play. They have a 3.7% dividend yield. And the dividend is safe, or let's see. So they made 1.05 billion. If we average out the 4 quarters, they make 900 million a quarter. So let's go with that. They make 900 million net income a quarter. The dividend cost exactly 520 mil a quarter. So as long as they're making over 520 million net income a quarter, they're good. But they do have a lot of debt, and it's just the negative growth environment is why the stock is struggling at only a 15 forward PE. That's kind of appropriate. Kind of reminds me of like a Sprouts Farmers Market. Sprouts Farmers Market as well is kind of in the same boat. Just look, 15 forward PE. And Walmart and Costco are two of the best ones. Walmart has Sam's Club too, which is really cool. So next up, Target Woke. Yeah, I remember that stuff. Yeah, I won't get into that, but they were promoting like Satanism and stuff. I don't even know if I can yeah, they upset a lot of their main core people, which is like moms and soccer moms and anyway. Hey, what's up, Ghost? He says, how are you doing? What platform is this? Yeah, this platform I'm on is called Moomoo. If you'd like to get it, it's in my profile bio there. Nokia first and then Big Bear AI. Yeah, hey, we just looked at Nokia a minute ago. So, and someone said Nebius. Flacito said Nebius, they report earnings tomorrow. So these are 2 companies NVIDIA owns. If we go to the NVIDIA portfolio right here, NVIDIA owns both of those companies, actually. Hey, what's up, Egg Mayo Sandwich? He says, are you entering CBRS? I haven't. Why the sad face? Hey, we'll check that one out. I know that's an IPO. Didn't they IPO like today? And hey, Francis, thanks for that gift there. If you have a stock you want me to look at, let me know. I appreciate that. So yeah, here's NVIDIA's portfolio: Intel, CoreWeave, and Nebius is their smallest holding. This is a data center company. Basically, all this company does is own a bunch of NVIDIA chips in a data center, and then they rent them out. So this is a cloud company. Basically, companies like Google and specifically Microsoft are renting out the GPUs from Nebius. But here's the part that scares me. Here's the good news. I'll go over the good news first. Phenomenal future revenue growth. Revenue's going to go from 227 mil this quarter to 590 million in 2 quarters. So revenue's going to 6x year over year. From 105 mil, it's going to 600 mil. So revenue's going to 6x. But the losses are going to worsen by 3x. So it's not this profitable endeavor. That's the tough part about this. Basically, this is a graphics card renting business. You rent graphics cards off this company, and it's a commodity, and it's super intensified competition. Nebius competes with CoreWeave and Iris Energy and APLD and Marathon, and it's tough because they all lose a bunch of net income. And so, yeah, they have phenomenal revenue growth. But the part that scares me is the net income forecast. So the way I'd value every other company is, look at a forward PE and stuff, but it's tough when the losses are going to worsen like that. And actually, here's kind of what Morningstar says. And I don't mean to be too big of a bear, but they report earnings tomorrow. You're right. They report earnings tomorrow. So wait for tomorrow because they're either going to go up or down a bunch. But check out what Morningstar says. They says they're overvalued. While the company is securing massive AI infrastructure contracts, significant caution is warranted due to a multi-billion-dollar cash flow burn, looming shareholder dilution to fund its capital expenditures, and a business model highly vulnerable to normalizing GPU rates. How's the free cash flow? Yeah, look at the free cash flow. Negative 1.2 bill, negative 1 bill, negative 500 mil, and they're going to lose 250 mil in net income, 300 mil in net income. I just don't really love companies that lose all that net income. But that being said, I bet the stock will probably still do good through the end of the decade. It kind of follows what NVIDIA does. It's like a high beta proxy to NVIDIA, but I still would be very cautious. So let's check out Corning. They just got, speaking of NVIDIA just bought this stock. And also, what's his name? Meta had a big deal with them. And no way, dude. Iced coffee. Thanks for the gift there. And shiny cardboard. Thanks for those Yo, it's gift star. I appreciate that. Shiny Cobra said my portfolio is up 50% since listening to this guy. Hey, I did not pay him to say that, but no. Hey, again, none of this is financial advice. I literally sell nothing. I'm just on here giving my opinion. I have no course, book, WhatsApp, Telegram. I'll never follow you, DM you. I don't coach. I literally sell nothing. Just give my opinion. So if you want to hit the follow button, I greatly appreciate that, and hit the like button. That helps out too. So check this out. Corning and NVIDIA announced multi-billion-year partnership with $3.2 billion invested into them. So NVIDIA's buying a big stake into this company because they're a big fiber optics company. So they're optical communications. They're using glass instead of copper in these chips because it runs faster and there's less, I think, like energy waste. But this is also a huge company that partners with Apple. If you've heard of Gorilla Glass before, which every iPhone today sold uses Gorilla Glass, that's actually manufactured and made by Corning. They own the patent. So Corning, a huge chunk of their business, 35% of all their revenue is their glass innovations that they sell to Apple. So yeah, 43% of the revenue comes from the US, 32% China, Taiwan, and all these other countries that also want their fiber optics. But they've had phenomenal margin expansion. The revenue grew 20% year over year. Oh, hey, thanks for blocking that person. Yeah, watch out for people in the chat that are like, first 5 people to DM me. Yeah, watch out for those people. But revenue's up by 20, profits are up by 43. So that means margin expansion. So the growth is finally back on Corning. It is pricey. It's very pricey at a 57 forward PE. But look at how cheap it is considering it trades at a 93 trailing 12 months PE. So it's really getting cut by a lot, which is good. And you get a good dividend. You buy it right now, you still get a 0.6% yield. But anyway, Corning's down 7% on the day. Amphenol is actually up 3% on the day. Amphenol is actually a big competitor that I'd actually like to buy more than Corning right now. They do pretty much the same thing, but at a 23 forward PE. Hey, what's up, KP? What app are you using? Yeah, hey, this app I'm on, it's in the link in my profile there. It's a brokerage, actually. It's where you buy stocks on. They ask for a bunch of information because it's a brokerage, and you got to pay taxes when you make money. But yeah, link in my profile there. Let's see. It's called Moomoo. You can just type it into Google, though. It's free. What do you think of Micron and SanDisk? Yeah, hey, I'm not buying the dip on them, but I really think they're going to recover. Right now, these memory stocks are falling on the day because the administration just came out and said they're going to have a plan to fix this. Yeah, it's kind of in the very middle of my screen here. Administration plans supply chain to address memory shortage. So they're going to try to help out and the stocks really trade off the sentiment around the memory shortage supply chain. But yeah, I think they're undervalued simply because of the forward PE. They only trade at a 7.8. This is real, and I looked at the numbers. They only trade at 7.8 times next year's net income. And here are the net income projections from the analysts themselves: 21 bill next quarter, 25 bill the quarter after. It's phenomenal. So. What's up, Jerry? He said, thoughts on IONQ? This is like a quantum stock. So this one trades with the momentum of all the quantum computing companies. Is there any specific revenue? Skywater Technology shareholders approve merger with IONQ. So they're actually acquiring a company. Skywater, is that like a different stock? Because it's Skywater. Skywater Technologies. Okay, so this company is actually being bought by IONQ. It's a $1.7 billion company, and they're actually net income positive, so that's good news. But back to IONQ, let's look at the future growth forecast because that would... Okay, so they're supposed to do 66 mil next quarter, 67 mil the quarter after, and I'm assuming that doesn't include the acquisition. And they constantly beat on revenue every quarter. But you just want to be careful because they lose a ton of money, which actually makes this stock kind of unbuyable. Actually, I would not personally own this one, or I'd just be super cautious. The losses are worsening. They lost 270 mil, 230 mil, 170, 160. So the losses are worsening, but the revenue is growing. So it's kind of good because the revenue is growing like crazy. But as the revenue grows, you really want to see the losses narrow. I do like the acquisition they're doing. Anyway, some sort of quantum computing company, I'd be very careful with this one. I wouldn't trust it. It's still one maybe you could have as a very, very small position, but definitely don't have that as like a meaningful size position. Just those net income numbers scare me. Are you done with your finals? Yeah, as of last Friday, I am fine. I have no more college basically for the summer. So I'm going to be streaming a lot more. Yeah, if y'all want to hit the follow button. I'm going to try and stream every day or every other day. Like from now on, I'm throughout the summer until school starts again. Yeah, that's why you don't listen to me. I'm just a college student. None of this is financial advice. Just here to give my opinion. So KG said the MMS is at a nice quarterly low. Should I sell Innodata after riding the crazy run? I definitely wouldn't sell all of it, but it's okay to trim some, but definitely don't fully sell out because their earnings were so good. It makes me so bullish on Innodata's future. So let's Corning versus Amphenol. That's a good comparison. I should do that actually. Oh yeah, we'll look at ARM after this and Palantir. Oh, Soothe. Remind me to get to Palantir, please. I love that one. Oh, hey, watch out for that person in chat there. Maybe. Okay, so anyway, here's MMS right here. Yeah, you're right. They're at a new multi-year low or like a 52-week low. They're, dang, if we zoom out, they're the same prices they were back in 2016. So this stock has done nothing for a decade. Let's see if we can figure out why. So program operations, clinical services. So it looks like the revenue growth is negative. That might be why. So revenues actually declined 4% year over year. So the lifeblood of the company, the sales, down 4%. That's not a great look. But they're still profitable. They're still making close to 100 mil in net income a quarter. But I think the stock, the revenue is just super slow growing. And when you grow super slow like that, yeah, you just get a low multiple. So they traded at 9 PE or 9 times net income, which is actually very fair. What's the net margin they run? So yeah, 5 to 7% net margin, not too shabby. Yeah, we just want to see the growth come back. Specialty business services looks like in the healthcare industry. U.S. Federal Service delivers end-to-end solutions to include appeals and assessment devices. Anyway, interesting name there. I do wonder why they're at a new multi-year low like that. All right, next up, yeah, let's do Palantir, I remember. And then we'll do ARM. That's a cool royalty company. What platform is this? Yeah, hey, Jay, it's on the link in my profile there. This is a brokerage. It's a brokerage called Moomoo. I have an affiliate link in the link in my profile there. So here's Palantir, phenomenal growth. And let's see if there's some news. There's always some good news around them. UK to grant Palantir contractors unlimited access to patient data. Okay. Palantir Ship OS program reduces Navy supplier arrival time from 200 hours to 15 seconds. Hey, that's not just a slight jump. That's a meaningful. Palantir warrants operating expenses to rise, future profitability concern. Palantir discloses tariff impacts disrupting customer operations. So maybe the stock is falling because of recent tariff sentiment news. Who knows? But here's why I absolutely love Palantir, and they're going to impress you. So half of the revenue actually comes from the government. So many police stations, the military, the Air Force all use Palantir's government software. And it's up 76% year over year, after grew 45, after grew 16, after grew 23. So yeah, someone said this is an evil company. Yeah, so they actually are giving the software, and this is the unethical part, which I don't like either. They're supporting ICE. So ICE is actually using Palantir software. And I was actually doing a recent class survey, actually over just about 50% of all Americans support decreased funding on ICE. So yeah, anyway, that government revenue is up 76% year over year. And the commercial revenue, which is a revenue with other S&P 500 companies like GE Aerospace and Google, that grew 95. That's the highest growth rate on the whole screen. Revenue's up 95, after grew 33, after grew 26, after grew 11. So incredible commercial side growth, and it crushes expectations every quarter. Analysts expected 616 of net income. They did 870 mil, and every quarter they beat by a huge chunk. So no wonder the stock has had such a crazy rally. They deserve it because the fundamentals are genuinely improving. Just organic revenue, like this wasn't from an acquisition. This is organic. Revenue's up 85% year over year. And on this 1.6 billion of revenue, they kept 880 million after tax, which means their net margins of 53%. This is a margin expansion play. The same time last year, the net margin was a 24. Now it's 53. It's more than doubled. Holy moly. So I would love, love, love to own Palantir. It's just too expensive. Even on the dip that they have, they're still expensive on a forward basis, forward PE. All right, let's see. It's the money behind the U.S. healthcare system. Oh, cool. Nice, KG. So are there any tips and tricks to learn how to analyze stocks like you, how to get good at reading financial statements? Yeah, I mean, I don't, the only way to learn from me is just watch the streams and watch my YouTube videos. I don't sell anything. I have no course book. I don't coach or anything. But yeah, the best way to I have a few YouTube videos on how I call them how I analyze a stock, and I'll show you the exact numbers I look at. And basically all the main metrics I cover over the stream, what all the metrics do, like the after-tax net income, the analyst expectations. Like there's so much stuff I look at and kind of blend together to form an opinion. What's your thoughts on LEU? What's up, Nick? So this is Centrus Energy. This is a uranium company. So they actually mine the uranium out of the ground, and uranium commodity has gone through the roof because the US and Canada, we are no longer sourcing uranium from Russia. And so we're actually trying to be more rare earth mineral independent. So LEU is a great Canadian and US uranium company. So wow, Centrus Energy secures $900 million DOE contract. Wow. Advances a $560 million Oak Ridge expansion. Centrus Energy partners with Fluor and Palantir. Identifies $300 million in cost savings. Centrus Energy explores joint venture with Oklo for, that's interesting, or that's some recent news around this one. What I've just liked about this stock is the consistent net income. I've looked at a bunch of other uranium companies, and all the uranium stocks, they have choppy net income. It's not positive every quarter for other companies. It'll be positive, then negative, and then negative, and then positive. But this company right here just consistently makes net income positive every single quarter. They don't lose money. Analysts see that continuing. They're supposed to make 22 mil next quarter. So, it's one of the best uranium companies, but they are pricey. A 73 forward PE. That's really expensive. There's also the URA. This is just the uranium ETF. So if you don't know what uranium name to buy, you can just buy the URA ETF. My favorite uranium stock of all time is Cameco CCO. This one's a really great one. Anyway, let's keep going here. Some more stocks. Also, Solstice is a cool one. I like to understand and learn entry, exit points on options. Yeah, hey, I actually don't do options. I basically never done options. I haven't done an option contract in well over a year, maybe 2 years. So I kind of just do the most boring thing. I just buy and hold great stocks and I don't trim them. I don't do crypto. I don't really buy any micro caps. Or if I do buy a micro cap, it's because they have great fundamentals. So but what I'm trying to say is you can get great returns buying quality stocks that you know and love, like Google. I bought them technically at an all-time high a year ago. From 1 year ago exactly, Google's up 139. I'm only up 135. It's not even like I perfectly timed the dip on them. I just bought them basically a year ago. Somehow I'm up 135. Google's been my best performer in here. Yeah, here's our total percent change in every stock. We're slightly down on McDonald's, but Google, we're up 135% on. I think we're just slightly green. Yeah, we're only up 1.1% year to date in there. Okay, next up I see, what stocks do you have? Yeah, hey, I have a ton of stocks. You probably want to check out my YouTube channel for a whole portfolio update. My biggest critique is I got way too many holdings for sure. But yeah, I got some popular names like AMD, Robinhood, Reddit, SoFi, Microsoft, Uber, a lot of S&P 500 names. All right, buy the dip on Broadcom. Hey, what's up? Oh, let me do Broadcom. I forgot about ARM. We got to get back to ARM later. And Palo Alto Networks. Hey, User 7. That's a really cool one. And we'll do Taiwan Semi too. And Striker. Hey, Ewan, what's the ticker symbol for Striker? I've not heard of that one. Please give me the ticker symbol and I can find it for you. So here's Broadcom. This is the company that's helping Amazon and Google make their own custom chips. So Apollo and Blackstone in talks to provide $35 billion for Broadcom financing. Okay. Okay. What's so impressive about Broadcom is the future growth expectations. Check out the net income forecast. It's supposed to hit in 2 quarters $12 billion of net income. It's insane because if we zoom out to current net income, it's never even been close to 12 billion before. So there's literally still going to be over 100% EPS growth happening this year. And that's why we don't value this company off current net income. We want to value them off next year's net income as a multiple. And if we look at it, look, they currently traded 80 times net income. That's super expensive. But if we look at them off next year's net income, it's more than cut in half. EPS this year is going to grow 100%. So they're having this year's 100% growth rate, and it's at a 38 forward PE. And you really want to do a 2 or 3 year out forward multiple, which makes them look even cheaper. So actually, surprisingly, even close to all-time highs, I would not trim or sell Broadcom. I think they're just going to continue to climb higher. Their VMware business is doing great, as well as their semiconductor solutions, what they're mainly known for. That grew this quarter 52%. That's the highest growth rate on the entire screen, and the growth isn't done after this because, net income's going to 12 bill. Pretty ridiculous. I'm super impressed. So, I'm so behind. Okay. How is forward PE being calculated? It's just the S&P 500 analysts. So I don't know, like for Broadcom, for example, they have a forward PE of a 7.8. Um, let's see. It usually says so. It's the first line at the bottom. This data is sourced from S&P Global with forecasted provided by a total of 17 analysts. So there you go. S&P Global, I love that company. They're also a stock. Let me do Taiwan Semiconductor. Then let's do, remind me to get to ICHR there, take profits. ICHR I want to do. And also Stryker. Oh yeah, what was it? Remind me to do SYK too. We'll do SYK next. So here's Taiwan Semiconductor. This is the manufacturer. So, NVIDIA, they just designed their chip. Taiwan Semiconductor is the one that actually manufactures them. They're the fab company. And their number one customer is NVIDIA. Their second largest customer is Apple. Apple also makes their own smartphone chips, and Taiwan Semi makes them. Apple increases MacBook production target to 10 million units, pays premium to Taiwan Semiconductor for A18 Pro chips amid supply constraints. Wow. Oh, wait, what was this down here? Apple explores Intel and Samsung partnerships for U.S. chip production to diversify beyond Taiwan Semiconductor. Yeah, so Apple's actually moving some of their manufacturing to Intel. So that's kind of what, but that wouldn't scare me out of Taiwan Semiconductor. They're still very cheap, in my opinion. If you look at a forward multiple, they're only at a 23 forward PE, which means they only trade at 23 times next year's net income. So look, net income's supposed to hit 21 billion in 2 quarters. And this is in US dollars. We've converted it from Taiwan currency. So yeah, 21 billion in 2 quarters. So I'm just super impressed with them. Like already their net income just hits a record every quarter. You won't believe the margins, dude. They're selling their chips at 50 to 60% net margins. It's just super impressive. And then they pay dividends. It's like NVIDIA with the higher yield. You get a close to 1% dividend. It's only at what was the valuation? A 23 forward PE. That's cheaper than like the S&P 500, a 23 forward PE. So anyway, if you're looking for a fab play, manufacturing play, Taiwan Semi is great. And they're also moving a lot of their manufacturing to America, to their Phoenix. They have a huge Phoenix, Arizona facility. So SYK was it, right? SYK. So Stryker Corp, dang, so this one has had a rough past couple months here, and they just reported earnings. Let's go see what those earnings were. And hey, Invested 09, thanks for that gift there. I appreciate you. So yeah, the forward PE on this one's also pretty cheap, only a 21 forward PE. So MedSurg and Neurotechnology. Oh, was this the company that top 10 largest orthopedic device companies in the world? I'm assuming this is one of them. Stryker deal to buy Amplitude Vascular Systems could reach 830 million. Oh, so they're actually buying a company for 800 million. That's actually pretty cool. There was some news where, I don't know if, well, let me not mention that. Anyway, MedSurg, this is a healthcare company. So MedSurg and Neurotechnology and Orthopedics. So that business is interesting. So when we combine all the revenue together, revenue only grew 2.6% year over year. So that's kind of a slowdown of the growth. Yeah, the revenue's only up 2.6. And but the profits grew by 7. Like they're still printing money. They're still making 800 and 900 million of after-tax net income a quarter, which is a 12% net margin. It's just, I think the top line growth concerns. Revenue's only up 2.6, but they are acquiring a company. So maybe that'll bring the growth back to this stock right there. They're probably reasonably valued at current prices. SMCI is king. Super microcomputer. Yeah, they do the commodity. They install the chips for you. Recently, the stock fell back here because they smuggled chips into China, and they were accused of that. I wonder if there's any Supermicro reports revenue, discloses material weakness in internal controls. Is there any more news here? Supermicro Computer reports Q3 revenue impacted by customer site readiness delays and AI component supply constraints. Anyway, let's go look at the actual numbers here because they did beat on earnings and they missed on revenue. So notice they expected 12 bill of revenue. They only did 10 bill of revenue, but they beat on the net income and that's real as well. Analysts expected 360. They did 480. So actually net income increased 344%. That is what you want to see. Margins are actually growing finally because their margins were contracting for the longest time. Back here they were running at an 8 to 10% net margin, and then it collapsed all the way to a 2 to 3. And now it looks like it's kind of recovering because they're giving customers these bulk deals. That was one of the big bad parts as well, is this huge margin decline. But it's recovering now. So I can see why they're having some good momentum. They deserve it. So KO speculation breaking new all-time highs. Yeah, Coca-Cola. This is a great dividend stock right here, dividend growth company. Actually, my brokerage is telling me that there's, I guess, a double bottom with a 95% rise probability, but it's a great dividend stock. If you look at the dividend, you get a 2.6% dividend, even if you buy it right now. You buy it right now pretty much at all-time highs, you're still getting 2.6% of your money back in a tax-free dividend. And that's a Warren Buffett approved company. If we go to the Warren Buffett portfolio, these super investors worth over 100 million have to make all their trades public by SEC law. Coca-Cola is 9.67% of his portfolio. So Coca-Cola is a huge holding by Buffett. And they own so many brands. Like some people are like, hey, I don't really drink Coca-Cola and sodas. Well, they own so many different brands. Like if you like teas and Smart Water, Sprite, Fairlife Milk, Vitamin Water, Gold Peak Tea, I love Topo Chico. Powerade, Fanta, Monster. Yeah, Coca-Cola owns Monster. 25% of it, pretty cool. What is this app called? Yeah, hey, I'm actually on a brokerage right here where you buy and analyze stocks on. If you'd like to get this app I'm on, it's actually in the link in my bio there, link in my profile, or you can just type it into Google. It's a brokerage called Moomoo. It's a free app, free brokerage. But if you end up depositing $100, we'll both get like a free stock if you use my link. Next up, we got Mason said BW. What's BW? Bab and Wilcox Enterprises. They've had a phenomenal rally. Check that out. I mean, a new 52-week high as of today. So if you basically, okay, this is the same prices they were back in 2018, but they're finally recovering. So let's see what they reported. So they had a huge revenue beat. Analysts expected 149 mil of revenue. They did 215. That's a huge beat, but they did miss on their revenue. I wonder, was that from an acquisition or I don't know. They are highly leveraged, more liabilities than assets, and they lose money every quarter if you average it out. Actually, operating profit, it says they make money every quarter. So technically the business makes money, but then the net income goes negative. Maybe it's from interest expenses from the debt. I don't know. But I'm assuming they rallied so much because of this great earnings beat. I wish I could give you more thoughts on this company. I'd just be very careful. What do they actually do? That might be a specialty industrial business. Let's go to their website right here. Maybe like AI components. State of West Virginia agrees to provide $10 million for hydrogen and carbon project. Construction awarded $35 million for power plant and industrial maintenance and service work. That's pretty cool. Awarded contract to evaluate carbon capture systems for Sweden waste to energy plant. Address. So anyway, some sort of industrial company headquartered in Ohio. Stock's at a new 52-week high, so congrats. Mayan said, hey, where should I put my $2,000? Need suggestions, top 5 picks. First off, I would just put it in great companies that you know and love, like a Netflix, Amazon, Google. I think Meta is one of the best buys in the market right now. Actually, I might actually go over Meta if someone wants me to. Meta's only at a 19 forward PE. I love what they're doing with AI and their advertising business. How do you feel about Amphenol right now that NVIDIA is moving away from them into fiber optic cables? Yeah, I heard about that. And that hasn't really officially happened, but that's kind of why I think the stock is kind of trending down. Basically, there's some chips, they're being switched from copper to glass fiber optics cables instead, which it doesn't matter for these chips where the cords aren't that long. But yeah, that's just been one recent reason the stock has fallen, but it's definitely oversold at a 23 forward PE. Let's get it. Oh yeah, let me Palo Alto Network. I'm so sorry, I forgot about that one, user 7. Yeah, then we'll do OXY and FICO, and yeah, we'll do a bunch of these. SOXX, yeah, that's a really cool growth ETF. So here's Palo Alto Networks. This is a cybersecurity company, and I'm a big fan of cybersecurity specifically. Out of all the software stocks to buy, there's Duolingo and Adobe, those I can understand being hurt by AI, but not not Palo Alto Networks, this cybersecurity behemoth that over half of the S&P 500 uses. It's an incredible subscription model company. So half of this company's business, 55% of it, is their subscription revenue, which analysts love. It's all reoccurring. It's predictable. It hits a record every year. And not just every year, but every quarter. It's up 13%, after grew 20, after grew 29, after grew 31. So incredible growth there. Their support revenue. And check out the forecast. Revenue is going to hit $3.3 billion in 2 quarters. If we zoom out to the revenue, it's never even been close to $3.3 billion before. I mean, the most recent quarter was a record, and it was $2.59 billion. So that's why this company is so expensive. In terms of evaluation, it's because there's so much future growth that's happening here that's projected by the analyst. Same with net income, and they're already net income positive. This is the other great news. They're making a couple $100 million of net income already a quarter. And it's supposed to hit $450 million in 2 quarters. So pretty cool subscription model cybersecurity company, but they're really too expensive to buy now, which is unfortunate. So yeah, SOXX, this is the iShares Semiconductor ETF. So if you've heard about this craze around data centers and AI and stuff, you're like, hey, I want to get exposure to the semiconductor sector, but I don't know which one to buy. Do I buy NVIDIA or AMD or Intel as a fab or Taiwan Semiconductor or Micron as a memory shortage play? Well, this ETF just breaks your money up for you into all of the top ones by market cap. So yeah, Micron, AMD, Broadcom, Intel, NVIDIA, Marvel. And this ETF has actually outperformed NVIDIA. While NVIDIA has been flat for about a year, or just gone up a few percent, the other companies like Micron and Intel and Broadcom have been picking up the slack and is actually making SOXX outperform NVIDIA because it has exposure to the memory shortage companies. Kind of cool. Is Micron too high to buy in right now? It is meaningfully. Maybe you could very, very slightly nibble, but I say that because it is tough to buy a chart that looks like this, but I also wouldn't be selling Micron, again, because of this forward PE of a 7.8. Micron only trades at 7.8 times next year's net income. Here, the actual forecast, it's supposed to hit $22 billion next quarter, $25 billion the quarter after. And, that annualized is $100 billion. They really only trade at 8 times forward net income. Pretty crazy. And I feel like they could just stretch higher. So here's FICO. Yeah, hey, what's up? Let's do FICO. They are being hurt by the government's Vantage score. There's like some increased competition. But here's what's so cool about FICO score. They have a fascinating business model story. So every time you make a big ticket purchase like a house or a car, you're paying like $5 or $6 for your FICO score rating. And what's cool is they've had phenomenal pricing power. They originally got into the ecosystem, got into all the banks by having these low prices, and now they're raising prices like crazy. They have phenomenal pricing power because if you're buying a house worth 6 figures, you don't care if you're now paying $12 for your FICO score instead of 6. So, or same with like a car. So anyway, FICO has had phenomenal pricing power, and they're finally at a good valuation. If you look on the right, they only trade at a 25 forward PE, which means they only trade at 25 times next year's net income. So yeah, they beat on earnings. They expected 225, they did 264. They expected 627 a mil of revenue, they did 690. So they really had a phenomenal beat this quarter. Net income was a record this quarter, never even been close. 265 mil. And it's just going to continue to be this strong. It's going to hit 240 mil next quarter, 240 mil the quarter after. So yeah, only a 25 forward PE. All right, next up, let's see. Oh yeah, Oxy, that's a cool one. That's a, and we'll do, what's up, Eric? We'll do Meta after this and Taiwan Semi. Hey, we actually, Thomas, we just looked at Taiwan Semiconductor like 10 minutes ago if you want to like rewind the stream or something. Or we can come back to them later. But Oxy is in the Warren Buffett portfolio. If we go to Buffett's portfolio right here, he has a big stake in Chevron, 7.4% of his portfolio is Chevron, and then 4.5% of his portfolio is in Oxy Petroleum. And, these stock has not done too good. The stock is the same price that it was back in 2007. So the stock has really done nothing. It has a decent dividend, a 1.7% dividend yield here. But they actually just sold off their most valuable asset. So if we go to their cash and investing activities, this number was positive $8 billion this quarter. Again, you really don't want this to be positive because that means they're actively selling out of their assets for cash. But I think it's just important context on also why the revenue fell year over year. It's because they just sold off their most valuable business to Berkshire Hathaway. Yeah, Berkshire Hathaway owns 26% of all their shares. But anyway, there was a cool statistic here. Okay, yeah, check this out. I guess realized price by oil, realized price by natural gas, net sales volume per day. Cool. Anyway, what's the valuation on this one? So a 10 forward PE, that's around average for an oil and gas stock, a 10 forward PE. You really own these for the dividend and for the diversification. You don't buy these to try and outperform the tech-heavy S&P 500 because these stocks don't do that. But you buy them for environments like the war fears that have recently happened where the stock rallies and it's a nice defense. When other kind of tech's doing bad, oil might do good. Oxy reports earnings with $3.2 billion net income driven by the OxyChem sale. Adjusted EPS beats, yeah. Oxy Petroleum cuts 2026 production guidance due to UAE gas field operational constraints. Okay. They halt new oil hedging after Iran-related volatility causes derivative losses. Cool. Anyway, oil and gas stock, you probably won't outperform the tech-heavy S&P. Hey, Hogus said actually TTWO. This is a cool one. This is a gaming company. So if you've heard of GTA 5, Rockstar Games, Red Dead Redemption, FIFA, Madden, they own all of those games. But the tough part is that they are not profitable. If we just look at a basic metric called net income, all they've done for years, these are cumulative losses since 2023, 2022. All they've done is just lose hundreds of millions in net income a quarter, sometimes billions on some quarters. So that's the one thing that makes this a really tough buy. It's the fact that they don't make any net income. The forward PE is 116. But right now, the stock is having a lot of momentum because of, you guessed it, GTA 6. They're in a really cool spot where literally at the end of this year, it's supposed to be November of this year, they have this asset, this game they're going to release. It's supposed to be one of the top 10 biggest games of all time. And as soon as they release that game, it brings them in billions of revenue and hundreds of millions of future reoccurring revenue. So that's what's kind of causing the momentum right now, but I'd just be careful. Yeah, Skagnes said GTA is priced in. That could be, yeah. Those net income losses just scare me. So, Eric said Microsoft. We actually have not looked at Microsoft today. This is one of my favorite stocks to buy ever. And I actually just bought them for the first time ever. Here are all my most recent purchases in order. And Microsoft is my third most recent purchase. We literally bought them on the dip. There's my buy order just a couple of weeks ago. So Microsoft, this is the number one software company, the number two cloud company, and potentially one of the best AI companies because they own 28% of OpenAI. So here's the funny part. One of the reasons Microsoft is falling is because they're the number one software company. They're saying software is going to get hurt by AI, but Microsoft is hedged as a 28% owner of OpenAI. And if these AI businesses take over, the cloud revenue should just boost as well. So yeah, anyway, 42% of the company is their software business, and that does over 120 bill of revenue a year. Incredible. Think of Office, Excel, OneDrive, PowerPoint, Word, all that does 120 bill of revenue a year. And then their Azure cloud, intelligent cloud, second largest market share, also does over 100 billion of annual revenue for them as well. And then they have the more personal computing, Xbox, Surface sales. That's kind of the low margin hardware business. But anyway, Microsoft is a money printer. Every quarter, they're making over 30 billion of after-tax net income a quarter. And that's what analysts project, 31.5 billion net income next quarter, and then 34 billion of net income the quarter after. So when we do a forward net income PE, Microsoft only trades at 22 times forward PE. It's a company that almost every S&P 500 company uses, Microsoft's software, their computers, the cloud. It's in so many sectors I love, and they're the leader in so many sectors. So yeah, that's why I just bought Microsoft. 21 forward PE can easily stretch up higher to a 28. All right, next up we got BuzzFeed I forgot they were public. What's their ticker symbol? BuzzFeed. Oh my goodness. Oh wow, they're up 118% on the day. Is there any specific news? More than doubles as Belgeared Media gets a lifeline. Looks like they're someone's trying to buy out BuzzFeed. I remember the BuzzFeed YouTube channel and stuff. Yeah, it's not a profitable business. The BuzzFeed company loses just money every quarter, 15, 30 mil, 7 mil, and the revenue's declining. The revenue's down 12% year over year. So, yeah, kind of think about this logically. No wonder this company was literally going bankrupt. The stock was at an all-time low and going bankrupt. Here's why. Simple math point of view. If you look in the top right, the market cap is 59 million. Let's say you buy the whole company for 59 million, or you're buying a company that literally lost you 15 mil, 30 mil, 7 mil, 10 mil, and this is by the quarter. So in just 3 months, or in just a year, you've already lost more than the whole market cap in net income, and the sales have declined. So, yeah. Hey, what's up, Daniel? He says, I also bought Microsoft as well. Nice, dude. Yeah, Microsoft, you can't go wrong. It's one of the best stocks in the market. Can you check? Oh, watch out for that person in chat there. Hey, what's up, no name? Do you think it will bounce back? Wait, IOSG? I don't even know. Or is it LOSG? Yeah, I can't find that stock, no name, but I did look up for it, but I don't know what you're talking about there. LOSG. Oh, and RHM. Oh, I'm slow. Okay, let me do this one here. I could lose that amount of money for similar investment. Wait, what? Okay, DoorDash. Let's check out DoorDash right here. This is an Uber competitor. I love Uber, and I love DoorDash as well. Eli said, what app or platform is this? Yeah, this is a brokerage, actually. So if you want to get this app I'm on, I actually have it linked in my profile there. It's an affiliate link, too, so it'll help me out. You can just type it into Google. It's a brokerage called Moomoo. My favorite app to buy stocks on, completely free, costs nothing. But anyway, DoorDash issues guidance exceeding expectations, plans 50 million Dasher gas relief program. Oh, that's cool. DoorDash reaffirms 2026 guidance, expects 200 million Deliveroo EBITDA contribution. Yeah, they acquired this Australian delivery company called Deliveroo. I remember when they did that. So they have phenomenal top line growth. If we just go to revenue right here, check this out. I mean, just from 2019, it has soared up like crazy. They did $4 billion of revenue just this quarter. And on this $4 billion of revenue, and this was technically, it says the net income fell 4%. It actually grew 29%, but they had the Deliveroo one-time adjustment. But they're printing net income. They're making, a couple $100 million net income a quarter. It used to be a tough buy because they were losing a couple $100 million, but now they're extremely profitable. Here was their acquisition. Yeah, last quarter they spent $3.12 billion buying Deliveroo last quarter. Pretty cool. Yeah, net income guidance is phenomenal. It's supposed to hit 330 mil in net income in 2 quarters. It's never even been close to 330 mil before. So they're going to hit record net income in the quarters to come. Here's, I guess, their total orders, market GOV. So 53 forward PE, though, does make it a tough buy. That is expensive at a 53 forward PE, but they deserve it for the growth. Morningstar says they're undervalued. A resilient platform flywheel driven by record membership signups, strong network effects in North America food delivery, and long-term margin upside from platform unification and autonomous deliveries will initiatives will drive long-term value growth. Pretty cool. If you like them, you'll love Uber too. So let's do PCG real quick. PG&E Group or Corp. Let's check it out. Unfortunately, this stock has not done well. The stock is the same price that they were back in the year 2000. So the stock has done nothing for a long while, but they're at a very cheap valuation, only trading at 10 times next year's net income. So actually, yeah, they're printing money. They're easily making like 600 to 800 million in net income a quarter. So they're printing net income. What's the revenue? Revenue's up 15%. So I wonder why the stock is struggling so much. Maybe they're just being disrupted by the AI thesis, who knows? But I mean, 855 mil a quarter, 0.9% dividend yield, 10 forward PE, seems pretty cheap. Oh, it engages in the generation, transmission, and distribution of electricity and natural gas to customers. So this is a utility company, I believe now. Oh, so that's why they traded a 10 PE, because they trade like a utility. They're probably a regulated utility, which do trade at like a low teen multiple. Oh, and they're in California as well. Oh, they're a California utility. Oh, these are almost unbuyable. Same with EIX. So that's why. This must be around, I don't know. I would stay away from the California utilities specifically. Trevor says, worst gas company in California. Hey, what's up? Hey, it's the homie Monkey D. Luffy. He says Symbiotic. This is a really cool robotics name. We'll look at RHM as well. And what's up, Kevin? Yeah, Arista Networks. I love that stock. So Symbiotic, if you're looking for exposure to robotics, this is one of the top names. I've looked at a lot of robotic stocks, and a lot of them are trash. like Rich Tech Robotics, Serve Robotics. They're all pretty bad. I wouldn't own those, but this is one with over 1,500 registered IP and patents, and it has real robotics that are already used by real customers. So yeah, look at that, 60 to 80% warehouse labor reduction cost, 99% accuracy. So basically they have these robots that do all your warehouse logistics for you. And Walmart is their biggest customer. Walmart, oh, I just disconnected my phone from my screencast. Oopsie. Anyway, okay. Yeah, Walmart CEO loves this company as well. They're actually their biggest customer. So yeah, they use these robotics to help out warehouse supply chains. And check out the revenue. This is the most impressive part. They are a behemoth. Revenue is real. You know, it's not like Rich Tech Robotics that's 1 million a quarter. They did 676 mil of revenue this quarter, up 23%. And Walmart loves them so much that Walmart decided to take a stake into the company. Walmart owns 11.8% of all the shares. They're the second largest shareholder. So yeah, Walmart's not only a customer, they're a shareholder because they love them so much. And they're getting net income positive now the past 2 quarters. So I'm a big fan of this one as a good robotics company. Hey, what's up, Wasanator? He says NVTS. Is that Navitas? Okay. Let's see. Is there any specific news? So they're diluting shareholders. Reports revenue of 8 million. Guides Q2 revenue of 10 million. So that's the tough part. They have lost all growth, and the numbers are just so tiny. It's like, look at what the numbers used to be. They used to do, not even that long ago, 2024, they did 20 mil plus a revenue a quarter. Now they're guiding revenue of 10 million next quarter. I mean, I just would completely stay away from this stock. You know, the growth is gone. Revenue's down 40 after it fell 40, losing 40 to 30 mil of net income a quarter. They have a good balance sheet though, but because of share dilution. But out of all the semiconductor stocks to buy, this one I don't like. Yeah, the net income forecasts are bad. I guess revenue's supposed to hit 9 mil next quarter, 10 mil the quarter after. It's just tough to trust, really. A $4.6 billion company, no forward PE, negative revenue growth. Actually, that's super expensive. I actually would not buy them. Hey, what's up, KP? What's next here? Can you check out POET and ALMU? Both of them are photonics companies. Yeah, POET got their order canceled for a breach of contract. Oh, wow, they basically recovered it. Let's see, actually. Yeah, so Marvel Semiconductor cancels all purchase orders from POET Technologies over alleged confidentiality breach. So that's why the stock tanked the other day. But look at that. After falling like 60%, they've nearly recovered it all. So I wonder if the news is like they re-put in their orders. I don't know. But the revenue is so tiny. You want to be so careful with this company. Check that out. Revenue was 300,000 this quarter. I guess in 2 quarters it's supposed to hit 900,000, but still that revenue is so tiny to trust. It's a $2 billion company. It's still a tiny company, but yeah. I'm assuming someone said they had to deal with Qualcomm. That might be why they're rallying up. The Qualcomm deal. What's this website? Hey, I'm actually on a brokerage. It's where you buy and analyze stocks on. If you'd like to get this brokerage, it's actually in the link in my bio there, profile link, free brokerage. So next up, let's do, I'm a little behind here. I do apologize if I'm missing out on some of the stocks here. Someone said, SoFi, IBM. Let me do SoFi. And then we'll do, we kind of just looked at Stryker like 10 minutes ago. So if you give me a minute, we can come back to Stryker. And then we'll look at Qualcomm. Okay, yes, Ania, remind me to get to Qualcomm after this. So we'll do Qualcomm. We'll try and get to Roblox. We've been streaming for over 2 hours now, so I apologize. I'll probably end the stream in like 30 minutes. But I definitely want to check out all these stocks that you guys have. So, and if y'all want to hit the follow button, that's the best way to support me. Now that it's summer, I want to try and stream every day, or at least every other day. I literally sell nothing. I have no course book, WhatsApp coach. I literally do nothing. Just on here, give my opinion. So SoFi is actually a really great growth company, in my opinion. The growth metric you want to watch on SoFi is their financial services business, and check out the year-over-year growth rates. Revenue's up 41, after grew 101, after grew 115, after grew 195, after grew a 441. So they're on an incredible streak of growth. And if we go to the revenue right here, this is what you want to see if you're just going to diamond hand a growth company. For the revenue, just to hit a record every quarter. Like organic revenue's up 42% year over year. Revenue's up 42, net income's up 134 to 166 mil. So they're not some startup. They're super growthy with the revenue, and they're already net income positive, making 100 to 200 mil in net income a quarter. And analysts project in 2 quarters from now, the net income's going to hit 240 million. That is ridiculous. So that's why SoFi deserves a higher multiple than this. It says this is a growth company, so you value them off next year's net income. They only trade at 22 times forward net income. That is undervalued. That's where you start to nibble on the stock. You know, if you wanted SoFi as 5% of your portfolio, don't make SoFi 5% of your portfolio today, but it's cheap enough so where you go ahead and make it like 1% of your portfolio. In full disclosure, I do own some SoFi shares. I actually regret every share I've ever sold a SoFi. Yeah, I got 24 shares left of SoFi in my Webull portfolio. So I might be biased, but I love them. I love that growth there. And the right now valuation is undervalued. Do you recommend if we copy your current holdings? I not really. You know, I'd always do your own research. A lot of the stocks that I own, like I wouldn't buy at current valuations, like Powell Industries. I'm up 1,000% on this stock. I actually would not buy this company at the current valuation. They're too expensive. So there are some stocks that are inexpensive though, but generally, yeah. And you know, sometimes I'll sell out of stocks or something. So you always want to, if you're going to hold something, you know, understand it, you know, always do your own research. What's the brokerage company you're using again? Yeah, the brokerage I'm on, it's actually linked in my profile, link in the bio. It's called Moomoo. It's a brokerage where you buy and sell stocks on. Or all these apps are brokerages. They're all linked in my link tree, but the one I'd recommend is Moomoo. The link in my profile there. Costs nothing, completely free. My favorite app to analyze stocks and buy stocks on. They have so many cool features like the super investor reveal and everything. So yeah. Next up, let's check out what did I want to look at next? I mean, I'm definitely behind on the chat. Was it Roblox? Oh yeah, I wanted to look at Roblox. I actually don't like this stock. I actually would not buy the dip on them. Surprisingly, like they're very oversold. Oh, ICHR after this. Okay, ICHR after this. So Roblox, even on the dip, I actually sadly would not buy them. And here's the good news and the bad news. Good news first, their daily active users are crazy good. Daily active users are 144 million, up from 85 million year over year. So incredible daily active users growth. But at the same time, the net income is suffering. They are highly leveraged. Look at that balance sheet, pretty much the same liabilities as assets. How are they going to pay off 9.4 billion of debt when your losses are worsening? You know, they lost 15% more than last year. They're losing 200 to 300 million more of net income a quarter. It only adds to the debt problem. So that's the tough part about Roblox. I guess the people playing the video game kids don't have credit cards, I guess. Roblox faces thousands of, I don't know if I can say that on TikTok and not get in trouble, but yeah, no. Safety issues under investigation, potential multi-district litigation looms. Okay, so analysts downgrade Roblox and cut price targets following revised guidance. So anyway, sadly, would not buy the dip on Roblox. They're just so far away from profitability, and it's just hard to trust. So, oh yeah, Qualcomm. Holy, I'm so behind. Qualcomm and then ICHR. And then, we literally just looked at Stryker there, like literally 10 minutes ago. So I don't want to cover a stock we just looked at again. But I am streaming on YouTube, and you are able to rewind it on YouTube. That's actually the best way to support me if you'd like to. Watch it from YouTube, stream it on YouTube as well. My YouTube channel is called Nathan Robber. The cool thing about Qualcomm is this is almost like a royalty company. They're close to an all-time high. It's a royalty dividend growth stock. If we go to the dividends, even if you buy it right now, you get a 1.8% dividend. And not just a 1.8% dividend, but check out what they do. Check out this first line here, the very first line. It says, Qualcomm collects royalty income on the majority of 4G and 5G handsets sold, as it holds many essential patents used in these networks. So Qualcomm's collecting crazy royalties, and they just issued some really good guidance. Qualcomm's CEO predicts AI agent devices will achieve mass adoption by 2027, reaching 1 billion units within 5 years. Qualcomm actually partners with OpenAI and Meta on wearable device deployment. So Meta has the Meta Ray-Ban glasses. They're also getting into smartwatches, which is pretty cool. So it's a cool dividend growth company. Here's their smartphone chip market share, a 22% market share for smartphone chips. So it's another semiconductor chip play with some patents as well. That's pretty cool. Anyway, that future guidance was why this stock went up. They're probably a little pricey at current valuations. So Don did it, said CoreWeave. Yeah, that's an NVIDIA holding. And hey, what's up, Paul? And remind me to get to IBM and LHX. I forgot about those. And then we'll look at FIX and Palantir. Yeah, hey, Lost. Yeah, remind me to get to Palantir for sure. That's a great one. So CoreWeave, that's a big NVIDIA holding. If we go to the NVIDIA portfolio right here, they own a bunch of Intel, which they're up over 7x on. And then they also own a bunch of CoreWeave because CoreWeave is a big customer. There's kind of like this circular thesis happening where like NVIDIA gives CoreWeave money, and then CoreWeave, with all of that money they receive, spend it purely on NVIDIA chips. So what does this company do? This is where you rent out data, or you rent out data centers. You rent out GPUs from CoreWeave. So that's kind of all they do. And it's a kind of a low margin, highly competitive industry that's not profitable. And that's the part that scares me. They have great revenue growth. Check that out. Revenue in 2 quarters is going to hit $3.44 billion. I can't express how impressive that revenue growth is, but the net income losses are going to worsen. They're going to lose $685 million next quarter, $601 million the next quarter. And that's down, that's a big loss from the previous year when they only lost $110 million. So the losses are going to 6x. The revenue is going to double. I just don't like companies that are that far away from profitability. So the way I normally value a stock is like a forward PE, but there is no forward PE. The forward PE is negative. But the revenue growth is there, but it's kind of just like the long-term thesis here. Like there's nothing proprietary. All they do is own NVIDIA chips and rent them out because NVIDIA or chip prices are so high right now. Some customers, they'd rather rent out GPUs than just buy new ones. All right, I panic sold Micron. I broke the rule. Hey, Maximus, I don't know. I wouldn't fully sell out of Micron. So let's do Palantir next. Palantir, this is a great growth company, like pure growth stock here, and they actually benefit from all the conflict. So Palantir, a lot of the revenue comes from the government. A lot of police stations, the military, the Air Force, all use Palantir software. That business grew year over year, it grew 76% year over year. After grew 45, after grew 16. So the growth rate is growing on the government revenue here. Crazy record. And this is organic, like they didn't acquire a company to get that growth. So that business grew 76%. This is the most impressive part, the commercial side. It grew 95. It basically doubled year over year. It's up 95, after grew 33, after 31. So incredible commercial side growth, which crushed the net income expectations. Analysts forecasted them to do $616 million net income, and they did $870 million net income. So no wonder this company is so expensive, and that's the part that scares me about Palantir and why I can't buy them. They trade at 87 times forward PE, which is still too expensive for me to buy in, but they deserve an 82 forward PE when they're growing and beating expectations at this clip. I mean, net margin expansion here, 53% net margins, revenue's up 84%, net income's up 302 because of that margin expansion. They have no debt. It's literally a fortress balance sheet. They have no debt whatsoever, ton of cash. So I just love the growth, but the valuation does scare me. So HIMS, yeah, the thing with HIMS is they reported earnings today. They're down 12% on a huge loss of net income. So they lost 92 million net income. So the bad part is like there is no forward PE here. Or well, there is a forward PE, but it's negative instead of positive. So the forward PE is negative 131. That's the tough part. Like the revenue growth did slow down as well. So check this out. The revenue only grew 3.66%, and the growth actually would have been negative if it weren't for their eucalyptus acquisition that they did this quarter. So anyway, if we go to the earnings hub, here's kind of what the highlights were this quarter. Subscriber growth reached 2.6 million, driving the 4% revenue growth, but the US revenue fell 8% due to changes in weight loss product shipping. But look at this, the second line. Their international revenue grew 969% year over year following their acquisition. So that was the eucalyptus thing. So that's what boosted the revenue more than it should have. But anyway, even Morningstar doesn't like them. They says they're overvalued. Aggressive market optimism surrounding its compound weight loss offerings marks significant margin pressures from an international expansion, and looming legal and regulatory risks in GLP-1 markets require caution. So yeah, it's just that they're not profitable. They're far from profitability, and it's tough to, slap a $6 billion market cap on a company with no profits. But they did have that revenue growth, but part of that revenue growth was, inorganic. What website are you using? Yeah, hey, again, this is actually a brokerage where you get stocks on. It's actually linked in my bio, the link in my profile there. It's a broker called Moomoo. It's a brokerage where you buy stocks on. They ask for a bunch of information because you pay taxes on stocks and stuff. So Erica, hey, thanks again for that gift there. Uber, let's do Uber stock. This is a phenomenal one. I also just bought them for the first time ever. So here's we haven't looked at Uber today. We've looked at DoorDash, but not Uber. I love this company. I really do. And their valuation is cheap even now. If we go to the forward PE, even right now, they only trade at a 20 forward PE, or 20 times next year's net income. I think that's very fair for the growth that they have. Here's a cool metric. This is their monthly active consumers. So not just monthly active users, but monthly active consumers are at 202 million, up from 171 million year over year. So more consumers on this product or on their app. Mobility, ride sharing, that's half their revenue. They're also doing delivery, which is Uber Eats, and now also business to business delivery. And the growth rate is growing over here. This is the growthiest business now. Delivery revenue's up 35, after grew 17, after grew 4. So they're bringing the growth back on their delivery side. It's $5 billion in revenue for the first time ever. And the revenue hits a record this quarter. So for the Q1 record revenue and profitability. It's not just a Q1 profitability, it's a record profitability quarter. The most profitable they've ever been was this quarter. And they also have a bunch of free cash flow. They're making every quarter $2 to $3 billion of free cash flow, close to $2 billion net income. They have no net debt. And so Uber does a ton of acquisitions. So actually, here's all the companies that Uber has a stake in. Uber owns 500 million of Grab shares, 300 million of Aurora Innovation. They own Lucid, WeRide, Joby Aviation, Serve Robotics, Marqeta. They own all of those stocks because they just have so much free cash flow. They just invest in other businesses. And they're also expanding their robotaxi business. They just acquired Spot Hero, which is a parking app I love. Anyway, Uber commits $10 billion to its AV expansion, autonomous vehicles. So yeah, Uber One membership surpasses 50 million members, up 50% year over year. Wow. Uber partners with OpenAI to launch driver assistant tool. Uber adopts new strategy for robotaxi policy. Cool. Anyway, it's really the platform where you go to book an Uber. That's where you make the money. It's not just the autonomous vehicle, but it's the platform you go to book a robotaxi on is where they make the money. What app is it? Yeah, hey, Kay, again, this is a brokerage, or it's an app where you buy stocks on, where they ask for a bunch of information stuff. It's in the link in the profile there, link in my bio. Or you can just type it into Google, brokerage called Moomoo. But yeah, that's my affiliate link if you want to sign up with that. And if you deposit $100, you'll both get a free stock. But you don't even have to deposit any money. You can get all these analysis tools completely for free. It's a free app, costs nothing. There's no way to even pay them money. It's just free. There's no subscription. They even let you pay them. And you get an ICE for free, a 3.35% APY. Actually, yeah, this app I'm on right now, it's called Moomoo, link in profile. They're also publicly traded. So this app I'm on right now, here's their stock, FUTU. App has 29 mil users. They print money. Check this out. They make an after-tax net income, $433 million. Even if this company were to go bankrupt, you're still FDIC insured. But anyway, app's called Moomoo, link in my profile. Anyway, what do you think about the Zoox IPO? I don't think Zoox is going to IPO. That's owned by Amazon. Amazon owns Zoox. And speaking of Amazon, they're expanding a 30-minute delivery service to dozens more cities. Like, that's crazy, the network they have. So Thomas said WKL. What is that one? I actually typed in WKL there, Thomas. I could not find that one. Unfortunately, I did look it up, though. What about the ETF DRAM, Mars? Yeah, this is your memory shortage ETF. So if you don't know which memory stock to buy, like there's Micron, there's SanDisk, there's Samsung, there's SK, there's Seagate, there's Western Digital. If you don't know which one to buy, you can just buy this ETF that diversifies you into all of the top memory names. by market cap. So yeah. What is Bintex? Do you know? I don't know. Hey, if you have a stock you want to look at, give me the ticker symbol and we'll check it out there. So, okay, next up, can you look at Iris Energy, please? Yeah, this is another data center company. I don't really love this stock right here, the long-term thesis here. Basically, if you're wondering what does this company do, all they do is own a bunch of graphics cards. So they own a boatload of GPUs. And what do those GPUs do? Well, right now, they just mine Bitcoin. So 76% of their revenue literally is they're using their GPUs to mine Bitcoin. But now they're actually getting asked by some companies like Microsoft. They're saying, hey, instead of mining Bitcoin, can we actually just rent out your GPUs for our cloud business? And they're saying, sure. But it's not a profitable real business, which is unfortunate. Like, this is the same thing. This is the exact same thing that CoreWeave does, the same thing Nebius does, the same thing APLD does, and Marathon. It's just low margin, or it's negative margin. You know, here at the net income projections, they're supposed to lose 100 mil next quarter, 160 mil the quarter after, and they're missing on revenue. Dang, they expected 220. They only did 144. Iris Energy is not profitable. Yeah, exactly right. Unfortunately, Ahmed, Iris Energy loses hundreds of millions a quarter, or just over 100 mil in net income a quarter, according to the forecast. I mean, this quarter was rough. They lost 250 million. And you see back here where it says they made 380 million, that was a gap adjustment. They tricked you. They didn't actually make money that quarter. Look, Q1 right here, after tax net income was 384 mil. The operating profit was negative 60 million. The core business lost money. This was a funny money adjustment. That's why you always got to blend the operating profit and the net income. The operating profit is the before tax, before interest, before adjustment number, and the net income is the after tax, after interest number. And so anyway, that's the scary part about Iris Energy that kind of makes it unbuyable. Yeah, look, even Morningstar says they're overvalued. While its pivot to AI data centers show rapid capacity expansion, an inferior user experience lacking value-added services and highly uncertain long-term AI infrastructure demand warrants significant caution. And they just, okay. Sorry if the stream went out for a second there. I had to fill out a CAPTCHA. They thought I was AFK. I guess I've been streaming for so long. Yeah, dang, we've been streaming for 2 hours and 20 minutes. I appreciate everyone that's here. And I don't mean to be bearish on Iris Energy. Looks like they're also doing an acquisition, but it's just a tough one to buy, knowing that, you know, they have good revenue growth, but it's just like what they actually do, I'm not super bullish on that. I'd rather be the company selling the chips to them. And actually, oh, wait. Oh, WKL is a Dutch stock. Oh, hey, maybe if you give me the name of that company there, Thomas, I can find out that stock by typing in the name. So, Fuel Cell Energy, that one I would not buy. Actually, we shouldn't even cover this one. Fuel Cell Energy. Actually, when I got this app right here, they give you some free stocks. If you want to get this app I'm on, again, I have an affiliate link in my profile. They gave me some free shares of Fuel Cell, and I sold them. But anyway, let's go. And dang, they're down bad ever since. Good thing I sold them, I guess. But here's why I wouldn't really buy this company. I mean, they just lose an unsustainable amount of net income. Here's their net income, you know, 30 mil, 30 mil, 90 mil, 40 mil, 30 mil. So kind of just for all of eternity, all this company just ever does is loses money. They haven't narrowed their losses. The net income losses have kind of just worsened. And the revenue, I guess the revenue's growing. Revenue's up 30. Oh my goodness. What am I clicking here? Revenue's up 30% year over year, but it kind of really hasn't, it's not up that much since 2018. That's why I think the stock isn't doing too well. Yeah, they're supposed to lose 26 mil, 25 mil. So they lose over 100 million a year. So simple math, easy logic. They lose over 100 mil in net income a year, and the whole company's worth 890 million. So they lose like 12% of their market cap a year in net income, and it makes it a tough one to trust. CorMedix, yeah, CRMD. This is a cool healthcare name. Yeah, hey, watch out for those people in chat there. Yo, I'll never follow you, DM you. I literally sell nothing, no course, book, coach. I'm just on here giving my opinion. So here's CorMedix right here. This is a very small one. They're worth $590 million in the top right. So here's the thing. Out of all the companies worth $590 million, because that's a small cap. First off, you don't put anything meaningful in the stock, and they report earnings in 2 days. But when companies are this tiny, you can't trust anything meaningful in this company. But here's the thing, out of all the companies worth $890 million, I want to buy the company that's starting to be really profitable. They did 128 mil of revenue this quarter, kept 59 mil on that. They did 92 mil of free cash flow, 30 mil last quarter, 29 mil the quarter before. So they're a company that's actually making a bunch of net income and free cash flow every quarter. So that's why I like this one. They're just profitable, but there is a lot of risk right here. Like their main product right here loses like their government subsidy next year, so the profits are supposed to go down. Here's the look here. Simple math though. Even though actually it's even smaller, they're worth 590 million. I want to buy the company worth 590 million that's forecasted to do 35 million of profits next quarter and 25 mil of profits the quarter after. So pretty cool in my opinion. And I'll show you my position in them. I own them in my Roth IRA is a very small position, and I am down pretty bad on them. I got 94 shares. I'm down 27%. But yeah, I still own them as like a very small position. It's kind of risk on position. Hopefully that was kind of helpful there. Hey, what's up, Dino? I am up on SOXS today. What is that? Oh, the 3X Bear Semiconductor ETF. So yeah, whenever semiconductor stocks go down, this goes up. And as we know, semiconductor stocks have been on fire, so it's basically at an all-time low. But yeah, if you bought this yesterday, not too shabby. That's a swing trading vessel. You never hold those for the long run. You just buy and never sell those. So someone said, Ruck, what's up? He said FCX. This is Freeport. Oh, and then we'll look at, we'll try and find Walters after this. This is your copper play. Actually, like the best copper stock, in my opinion, to exist. They also benefit from gold as well. They have a little gold mine, but mainly it's a copper company. And out of all the copper stocks, I've looked at them all, this one makes the most consistently good net income. I mean, if we just zoom out, like every quarter, it's always like over $1 billion of net income if we average it out. So that's why I'm impressed. They're making over $1 billion net income a quarter. You get a good dividend yield, basically 1% dividend yield. 28 forward PE. It might still be a little pricey for a commodity stock, but the price of gold and the price of copper are like close to all-time highs, and they just follow that trend. So it's kind of just a play on the commodity of copper. If copper's doing good, then they're also doing good. So Walters, hopefully I can find that one. Walters. Oh, we found it. Here's the ADR ticker symbol. It's WTKWY. Yeah, we found it. Nice there, Thomas. So this one, yikes, has done very bad these past couple months here. Like, that's a pretty devastating fall. They're a European company, so we'll convert the currency to US dollars. They're at an 11 forward PE, which is very cheap. So they're in tax and accounting. They're in health, financial, and corporate compliance, legal and regulatory, corporate performance, and environmental. That's like, I like how diversified that they are. That seems pretty nichey. You get a 4% dividend buying this stock right here. I don't know if they're just being out innovated by AI or something right now, but I mean, the 11 forward PE is cheap. I mean, all the fears have got to be priced in at this point. These European companies report in halves and full years. That's why it says H1 and full year or FY. Their print to money for the full year 2025, this was a record. They did 1.54 billion net income. So record net income, but record low stock price. It's weird. Hey, Nathan, which do you like better, GLW or COHR? Have GLW, it's been super well. Let's check out Coherent. So, wow, they've both done phenomenal. These are both two like AI infrastructure plays. Is there any specific news? Wow, NVIDIA invests $2 billion into Coherent with multi-billion-dollar purchase commitments as well. So yeah, NVIDIA is trying to lock up the supply chain for them. So yeah, data center communications. So that's what they do, like fiber optics, cables, stuff like that. So communications, that business is up 40% year over year. And look at the forecast by analysts. Revenue is supposed to hit 2.1 billion. And the net income is supposed to hit 250 million net income as well. So yeah, they're going to be extremely profitable following this NVIDIA investment. And Corning's pretty similar as well. And I think NVIDIA also just bought them. Yeah, Corning secures a 3.2 NVIDIA investment for U.S. optical manufacturing. So a big fiber optics company. This is also a huge display Apple customer. So if you heard of Gorilla Glass, which all nowadays iPhones use, they own Gorilla Glass. So 35% of Corning's revenue comes from their Gorilla Glass revenue, which Apple uses. And then their optical communications is their main growth driver. That's up 36% year over year. After grew 45%. So nice growth there. And that's only supposed to go up even more with the data center and NVIDIA investment. What is this website? Yeah, hey, this is actually a brokerage. It's where you buy, sell stocks on. If you'd like to get it, it's the link in my profile there, link in my bio. Broker called Moomoo. It's an affiliate link too, so it'd help me out. But you can just type it into the App Store, Google, brokerage called Moomoo. What is the ticker for that copper one? Oh yeah, that was FCX. That was Freeport. You can also rewind on the YouTube stream, which is cool. If you miss anything, yeah, feel free to rewind and watch the stream from YouTube. Also watching Marvel. Hey, what's up, Sharkwater? Yeah, Marvel too. Yeah, they're a little expensive, but I really like Marvel. Which top 5 stocks would you pick to invest in today? So I'd buy Uber, and I did just buy a lot of these for the first time ever. I'd buy Meta right now. Netflix is pretty decent. I'd pick more than just 5 stocks. You know, I want to be a little bit more diversified than that. But just the companies I love are the companies that I do own, you know. Actually, here's a fun thing you'll see. I haven't been buying anything as of the past week and 2 weeks because everything's been on fire, but here are all my most recent purchases in their exact order. So I actually just bought Uber, Microsoft, and AppLovin for the first time ever. And this was literally just 2 weeks ago or like 3 weeks ago. There's my buy order. They're down there. Bought Uber and Microsoft and AppLovin that exact day. So things have been a little rally, but if things fall again, like looks like things are actually recovering. Micron's only down 6%. But if things fall, I'll be buying more of those companies. Actually, I just bought more food too. Oh, I should have covered that. Yo, I just bought a bunch of this stock right here yesterday, FUTU. And if you're wondering what is FUTU, that's actually this app right here, this brokerage I'm on right now, publicly traded. So literally this app I'm on that's called Moomoo. If you look in the top left, this stock is called Moomoo. Again, if you'd like to get this app called Moomoo, I have an affiliate link in my description bio there. If you deposit $100, you'll both get 10 free stocks. But yeah, I just bought literally a couple $100 more of Moomoo stock yesterday. They only trade at 11 times net income. Again, even if this brokerage goes bankrupt, you're still FDIC insured, but this company's nowhere near bankruptcy. Before tax, they made 530 mil. After tax, they made 433 million. And that's on revenue of 827 million, which means their net margin is a 52%. These brokerages print money. That's why I'm a fan of Robinhood. I'm a fan of Webull. I'm a fan of SoFi, and I own all those stocks. I own SoFi, Robinhood, Webull, and Moomoo. They make a lot of money from commissions and interest income. Look at this interest income specifically. It's up 50% after it grew 52% the previous year. What's so cool about this app is, and this beats like your high yield savings account at a bank, they give you for free idle cash. They give you a 3.35% APY on your idle cash while it does nothing. They earn a 3.8% APY on your idle cash, and they just pocket the difference. It's kind of smart by them. But yeah, anyway, my favorite app to buy and analyze stocks on is completely free too. They cost nothing. There's no way to pay them. There is no subscription to pay. Like with Robinhood and Webull, there's Webull Premium that costs $4 a month, Robinhood Gold, which costs $5 a month, but not with Moomoo. There is no way to pay them. It's just all features access. My favorite app to buy stocks on. Link in bio. Next up, let's do NU. What's up, Sean? And JEDI. What is Jedi? Drone and Modern Warfare ETF. And then we'll look at NU and Redwire. Oh, and Shopify. What's up, Hector? So here's Jedi. This is the Drone and Modern Warfare ETF. So I'm assuming whenever there's war fears, this kind of benefits from that. Yeah, someone was saying Redwire earlier. Redwire is the largest holding in here. Then it's Ondas, C3AI, Archer Aviation, Red Cat. So Redwire is the top holding in this ETF. You know what? Enelio, let's cover Redwire itself since we're already on it. Is there any specific news? Redwire reports record backlog of $498 million. Wow. So they have a backlog of $498 million. What's the market cap? So they're worth $2.28 billion. So a good chunk, like 30% of their market cap is a backlog. That's really impressive. So we really want to look at a future growth. So yeah, revenue next quarter is supposed to be 108, then 123. They are still supposed to lose net income though. So that is kind of tough. But they did have nice growth. You know, revenue's up 57% year over year, but they lost 76 mil. They have a good balance sheet though, so they can afford these losses. But yeah, we definitely want to see them narrow these net income losses and kind of grow faster. I mean, it doesn't look like, revenue's going from, they missed, there's 133 to 123. So I don't know, some sort of drone company. Nothing's really blowing me away there. I did like the top line growth. So let's do Shopify. Yeah. Actually, you know who owns Shopify? Cathie Wood does, which, you know, honestly, we've lost a lot of respect for Cathie Wood because her ETFs have done so terrible. you know. Can we actually see all of her funds? I think it like lists, yeah, here all of her funds right here, like ARKK. When we combine them all, we can see the exact top holdings. Oh, she just decreased her AMD position. Anywho, one of the stocks she owns, 3% of her portfolio is Shopify, and I absolutely love Shopify. I used to have a Shopify store, and I paid for their highest tier subscription, and even when you pay for that highest tier subscription, you still have to pay Shopify 0.25% of every sale. So they just collect basically high margin royalties on every transaction. But check out the revenue. This is the most impressive part. The revenue hits a record like literally every quarter. That is what justifies the stock price appreciation and the high multiple, the fact that they're this growthy. So, and it's not just the revenue, but the profits as well. If we zoom out, they're the most profitable they ever been. They used to kind of lose a couple hundred mil a quarter, but now, they're making a couple hundred mil a quarter. So very impressed with Shopify. And another thing that takes a lot of risk off the table, huge safety net, is the fact that they have no debt. Shopify is debt-free. How much cash they got? 5.7 bill of cash, no debt. So they're just still expensive. Like even on the dip, they are slightly expensive. Let's see. Shopify signs multiple luxury brands, including Louis Vuitton. Wow, so Louis Vuitton has their own Shopify store. I know as a lot of Mr. Beast videos are sponsored by Shopify. He has all his Feastable stuff on Shopify websites. So it's a cool e-commerce company. Any other news here? Anyway, I love the revenue growth. I just wouldn't go crazy buying it yet. McDonald's is a buy now. I completely agree, Eric. McDonald's is a buy. So as we know, all the food stocks have been struggling. Like it's not just McDonald's. Like as we can see, McDonald's is on a clear dip. But if we look at their competitors, these are the real scary parts. Like Wendy's, they're at like an all-time low. Wendy's is the same price as they were back in 2008. Jack in the Box, like General Mills, even the packaged goods. So anything food right now, anything food, the stock is tanking. Just heard a weird noise. I don't know what that was, like a whistle. Oh yeah, NU. I said I'd get to that one, Sean. Thanks for reminding me. Yeah. Hey, what's up, Steven? Good to see you. Yeah, we've been live for 2 hours and 40 minutes. Oh man, this has been fun. I appreciate everyone that's here. If you do enjoy, please leave a like. That's the best way to support me. I sell nothing. Literally sell nothing. And hit the follow button if you'd like to. I'm going to try and stream every day and every other day this summer. So anyway, here's NU Holdings. This is a crypto bank out of Brazil. And that's important to note because 92% of all the revenue is strictly from Brazil. So this is a crypto bank out of Brazil, but I actually like that they're in Brazil because that's where people actually use crypto for transactional purposes. So if we go to their quarterly revenue, or this is actually net income. This is after-tax net income. This is incredible. It's a record this quarter. Never even been close. Up 62% year over year to 894 million in net income. And that's converted. This is in US dollars. This is in US dollars, real after-tax net income. And they're actually applying for a US banking charter right now, which is pretty cool because right now they don't have one. But yeah, this is your main Brazilian bank. So yeah, revenue grew organically 56%, net income grew 62%, net margin of 20%. Very just profitable company, and they're not even expensive. It's a way you can get exposure to crypto if you don't have any, and the valuation is only at a 15. So you only trade at 15.8 times next year's net income. Pretty crazy. What is the IPO for Elon's new upcoming rollout? I don't know, Gracie. I think you might be talking about the SpaceX IPO. Or I don't know, or maybe XAI, I have no idea. But I don't think a SpaceX is going to IPO till later this year. All right, ADMA, yeah, that's some healthcare manufacturing company. They've been, dang, so they reported earnings. Let's go, I have not looked at their earnings. I am very curious to see what they did. So, ooh, a big miss on revenue. Wow, okay. Yeah, I can see why they gapped down. So analysts expected 139. They only did 114. But they rose margins. That's actually super impressive. They only missed by 2 million on net income. Their margins actually expanded phenomenally. So look at this. The revenue actually declined 0.3. And this is real too. Real operating profit, real net income grew 50% year over year, which means their gross margins are up 32 to a 70% gross margins. Net margin is at a 40. A 68% growth. I'm actually going to re-put them on the watch list. I know they missed on revenue, but they're not losing the pricing power. They still got the margins. So very interesting one there. What's the valuation? What's the PE? They trade at literally a 9 forward PE or 9 times next year's net income, but maybe it's because of the top line growth. Jojo said, what is this app? Yeah, this is actually a brokerage software where you buy and analyze stocks on. If you'd like to get this app, it's called Moomoo. It's actually linked in my profile, my bio there. It's an affiliate link, so it helped me out. But yeah, if you deposit $100, we'll both get a free NVIDIA stock, I think, or fractional share. Yeah, a brokerage called Moomoo. Link in bio. Next up we got, QLDY. I think that's a covered call ETF. I'm not really a huge fan of these. Yeah, so basically, NASDAQ 100 Lightning Spread Income ETF. So yeah, it has a 25% dividend. Basically what this does is it sells calls on the NASDAQ. And the yield is so high because whenever you sell calls on the NASDAQ, you're almost always going to get called on them because the NASDAQ always goes up. So like, would I personally sell a covered call on the NASDAQ myself? No, because I know it's going to get called, but also I'd get a lot of income for doing it. So you buy this, point being to maximize your dividend income. Don't expect to outperform, the tech-heavy S&P or the actual NASDAQ. That actually underperforms by a good margin, the NASDAQ. Sharkwater, what's up? He said, Texas Roadhouse report, good. Let's check it out. TXRH, Texas Roadhouse. Yeah, this is a really nice dining restaurant. So, and then we'll look at Pfizer after this and a few more. So Texas Roadhouse, what's their valuation? I remember they're not actually that expensive. This is like a little pricey, probably slightly expensive, but a 27 forward PE isn't too shabby. Let's see what they're doing. So they have one of the best management teams of any restaurant. So revenue's up by 12% year over year, and they're making good net income. They're making like easily, if we average it out, over 100 million of after-tax net income a quarter. You get a 1.5% dividend. So even if you buy the stock right now, you still get a decent dividend. Actually, I like McDonald's right now, but let's see how they beat specifically. So yeah, they beat on net income. They expected 118. They did 123. And it was a beat on EBITDA too. So yeah, they did beat. Maybe they rose their guidance as well. But yeah, nice little gap up on Texas Roadhouse. How did you get so good at research? Did you take some sort of financial class? No, I'm kind of just self-taught, and I'm definitely not an expert. I'm in college right now. So yeah, none of this is financial advice. I'm just going to give my opinion. And hey, thanks for coming to the YouTube stream, Eddie. I appreciate that. That's the best way to support me. So Pfizer stock, PFE, this is a cool healthcare company. You also kind of buy this to maximize your dividend income because technically, here's the truth. Pfizer stock is the same price as they were back in 1998. So if you bought the stock in 1998 at $26 a share, it's still at $26 a share to this day. But you buy this to maximize your income because they have a 6.61% dividend yield. So you get 6% of your money back in a dividend, but no stock price appreciation. So that's what you're kind of hoping for. You get the 6% dividend, and then you're kind of hoping for like 1 or 2% stock price appreciation on top of that for a 7 to 8% total return a year. I remember they were going crazy when the COVID vaccines were selling like crazy, but anyway, here's the net income forecast. They're going to make $2.5 billion next quarter and then $3.5 billion the quarter after. Here's how you can tell if a company has a safe dividend payout ratio. You go to the cash flow statement, you can see how much exactly the dividend cost every quarter. And the dividend cost exactly $2.45 billion. So as long as Pfizer makes over $2.45 billion of net income a quarter, they can afford the dividend. And next quarter, it's going to be close. Only $2.5 billion, they can just barely afford the dividend. And then they make $3.6 billion quarter after, which they'll have an extra $1 billion to play with. But yeah, basically, you don't really buy that to outperform the S&P. You kind of buy it to maximize your dividend income. I know Pfizer also just acquired Metsera, which is a weight loss company. So they're actually getting into the weight loss industry. I think they have like a 5% market share or something. How'd you learn to utilize the Moomoo features? Just with time. I've been using this app for so long. And I actually have some YouTube videos on how to like use this app. And all right. Didn't you graduate? No, I didn't graduate, but the semester ended. Got my credit hours and finals just ended. So, but thanks, Sharkwater. Yeah, I'm finally free. So I'm going to be streaming a lot more over the summer because I'm more free. Check out, Ben said HROW. What is this one? So Haro. Okay, dang, they're down 20% on the day. So, they reported earnings. So let's go see what their actual earnings were. They must have given bad guidance. So yeah, dang, look at this. Analysts expected 52 mil of revenue. They only did 44. And net income was even worse. They expected them to lose 15 mil. They lost almost double that. They lost 28 million in net income. So no wonder the stock is down 20%. You miss on revenue by a good chunk, you miss on net income by a good chunk. That'll send the stock down. So, and they're kind of highly leveraged. Looks like they're reaffirming some sort of guidance, 350 to 360 million full year outlook. They did a little acquisition. Anyway, I'd just be careful with that one. The net income is kind of choppy. Branded in Prism RX, so it's some sort of healthcare company in the US. So, they're actually in the hemp industry. I might get in trouble if I let's see. They have an investor presentation. I do like going over the investor presentations. So here's I guess the dry eye disease. So it's like a eye dry eye disease, Ocular anyway, here's kind of what they sell. Here's the guidance right here. Something 2026 estimate, 357 mil of revenue, and their adjusted EBITDA is supposed to hit 90 mil, which will be a record on that. And here was their Q1. They just reported this. Yeah, negative 12 mil of EBITDA this quarter. Full year 2026 outlook. Anyway, I like going over the investor presentations sometime. They always kind of put lipstick on it, but will you tell us your YouTube? Yeah, my YouTube channel is called Nathan Robert. Yeah, please. That's the best way to support me. Yeah, I'm major. Yeah, I have a finance major. I minoring in fintech. What's up, guy? How's it going? They're an eye pharmaceutical company. They buy a lot of companies with a moat and integrate their products into the pipeline. Yeah, My Music. That was a pretty cool eye company. Thanks for that. Oh, what's up, Matt? He says PL. What do you suggest for the long term? Great companies, great S&P 500 companies, or just the S&P 500. But yeah, the most quality stocks, even the stocks that are at all-time highs, those are the companies I recommend long term because they're the most quality. So here's Planet Labs. This is a huge Google partner. Google is actually the largest shareholder. If we go to shareholders, Alphabet, which is Google, owns 10% of the entire company. And also, let me show you what this company does. Planet.com is their website. They have these Pelican satellites that let you zoom in. Like 10 years ago, Google Maps used to be really bad, but now you can like really zoom in, and Google Maps pays them for their data, for their satellite data. So if we go to the revenue, the most impressive part is the fact that they just hit a record revenue. Revenue's up 42% from the previous year, but bad news, they are still losing a lot of money. Like they lost 150 mil this quarter, but that top line revenue growth and the momentum around the space industry with the SpaceX IPO, the Artemis 2 mission launch, these space stocks have been to the moon. Just open an account. Why are they asking for money? Yeah, Erica, this is a brokerage right here where you buy and sell stocks on. You get paid taxes. Hey man, discovered your channel a few days ago and I'm loving it. Cheers from Singapore. Hey Sora, dude, thank you very much. I appreciate that. Thank you. Okay, last one. Someone mentioned SpaceX. If you want to get ahead of the IPO, check out DXYZ. Yeah. So this is a private equity. It's pretty much an ETF. It's technically like a stock, but it's an ETF, call it, because this owns a bunch of private equity companies. So yeah, the Destiny Tech 100. Check out what it owns. Anthropic is 18% of all the company. SpaceX is 15. OpenAI is 5. I've never heard of Open Evidence, Databricks, Beast Industries. Oh yeah, this is the real Mr. Beast company. They have a share of Mr. Beast's Beast Industries company, which is Feastables and the YouTube and stuff. So anyway, cool little ETF there. You're right. All right. Next up, hey, shout out to homie, the member Louise. Good to see you, Louise. Let me know if you have a stock you want to look at before I go here. Yeah, we've been streaming for almost 3 hours. Yeah, my phone's on 11%. We're getting low here. We'll probably look at a couple more and then I'll get out of here. All right. Can you check out Toast? Wait, Sonia says FCX is a better fee. Let's see what this one owns. So Fundrise Innovation Fund. I think this is another private equity company that owns like Anthropic, SpaceX, kind of like that. There's also the Robinhood Venture Fund. So any penny stocks you recommend? Not really. And if I do recommend it, it's as a super, super small position, but CorMedix is one that I like. They're only worth $590 million. And here's the thing. Out of all the companies worth $590 million, I want to own the company that, made 92 mil of free cash flow, projected to make 35 mil of net income next quarter, 25 mil a quarter after, super growthy, So that's my favorite one. I do own them and I'm down bad on them. And there's a lot of risks with that one that I just don't want to spend the time mentioning, but there is a lot of risks with that company. But I do really like the profits they make. So ICHR, and let's do this one. And then we'll look at some of these other ones. Oh, yeah, like Toast. I forgot about that one. So here's iCore Holdings. They are pretty much at an all-time high. So if you've ever bought this stock, congratulations. You're definitely up on your money. Let's go see what they do. So I'm assuming some sort of data center infrastructure. So they design, engineer, and manufacture critical fluid delivery subsystems and components. Well, that sounds nichey. Well, let me go to their website. So fluid delivery subsystems for semiconductor equipment. So I'm guessing maybe liquid cooling. They maybe liquid cooled data centers, something like that. I mean, view products, okay? View products. I guess here, so they sell valves, this sort of stuff. I'm assuming that's really in demand from data centers, and the oil and gas industry has been on fire because oil prices have been so high. So CapEx is going up. But yeah, it looks like the growth hopefully is going to come back soon because, right? Oh, it is going to come back. Look, revenue is going to go from 230 to 315 year over year. And net income, they're actually going to finally make net income because if we zoom out to current net income, they have not made net income since 2020. All they've done is lost money ever since, but now they're actually going to make 5 million net income next quarter and 9 million the quarter after. So they're finally going to stay a consistently net income positive company, and that might be why the momentum is so successful. All right. In at $17. Oh, wait, and ICHR. Yeah. Oh, wow. In at 17, dude. And you didn't even have to I'm assuming you didn't even buy this stock that long ago. Like you bought this stock this year, potentially in January of 2026, and you're already up like crazy. So yeah, congrats on that one, man. Yeah. I like that they're finally going back to net income positive. So let's check out KLAC. Oh, and ServiceNow. So, hey, Damien, we've already covered ServiceNow a couple of times, but since we're about to end the stream, I'll come back to them at the very end. But I'm also streaming on YouTube channels called Nathan Robert. You can rewind and find it, but we'll look at them at the end there for ServiceNow. So here's KLA Corp. This is another one that's at a crazy all-time high. So congrats if you've ever owned this stock. You're definitely up on your money. They are down 4% on the day. But let's see what they do. So semiconductor process control. So yeah, no wonder they're at all-time highs. So they're also in printed circuit boards. So cool. The future revenue forecast is phenomenal. Revenue is going to go from 1.1 to 1.44. Oh no, that's net income. This is net income actually. That's even more impressive. So EPS is going to grow like crazy. Yeah, revenue's going to 3.9. They're going to make 1.5 billion net income on that, which basically means they're going to have a near 40 to 50% net margin. They're already at a 35% net margin, already making over $1 billion of after-tax net income a quarter. So I'm really excited to see what the future holds. And that's assuming they don't beat on expectations too. So that's KLA Corp. Some sort of probably overvalued though. It's kind of tough to buy them. So Oklo, yeah, Oklo, I really wouldn't buy this one. This is a nuclear small modular reactor startup, and they're basically not going to have any revenue until 2030, which is unfortunate. Look, if we go to revenue analyst forecast here, it says 0, and the orange line is 0 because they've never sold anything. They've never sold a product or service, and they don't plan to until 2030. So yeah, I wish I could give you real thoughts on this company, but it's a startup, and it's really tough to value a startup that's worth, the market says this is a $12.8 billion company. They have no revenue, and they're losing a lot of net income. I can't justify a $12 billion market cap. If this company is worth $12 billion and has no revenue and loses a ton of net income, how about these other companies like Dave right here? This company's worth $3 billion. It's like a fraction of that company. This company's worth only $3 billion. And this company has incredible revenue growth, 150 mil of revenue, prints net income, 50% net margins. That market cap is not deserving, in my opinion. So yeah, let's go ahead and do ServiceNow right here. This is a software company that's falling because all of software is. You look at a Salesforce, an Adobe, those kind of names, they all have a very similar kind of downtrend. And ServiceNow is actually, oh yeah, they just acquired Armis, this cybersecurity company. I love what they're doing, getting into cybersecurity. But the one bad thing, I'll show you the 2030 forecast. Yeah, look at this top line here. This is cool. ServiceNow targets $32 billion of revenue in the year 2030. So for the full year 2030, they're forecasting 30 bill of revenue. If we go to the full year 2025, it was 13 billion. So for the next 5 years, revenue is going to CAGR like 30%, and it's going to more than double in just 5 years. So that's why I think this company definitely deserves a high multiple, and they do have a high multiple. And that's the one scary part. So the forward PE is a 41, which means they trade at 41 times next year's net income. I feel like this maybe could still go down a little bit. It could fall to like a 37, a 38. So now's not the time to fully buy the dip. Like if you wanted this as 5% of your portfolio, don't make it 5% today, but maybe go ahead and make it 0.5%, like a slight nibble, nothing too meaningful yet. But I do like that 2030 forecast and the fact that they're already super profitable. Yeah, if we go to ServiceNow's net income right here, they're already making like 500 mil of net income a quarter, and it's only going to grow from here. So pretty cool. Futu versus SoFi at the moment. Yeah, dude, they're both. The truth is, the Vigilante, they're both a steal. And I did just buy a bunch more Futu yesterday. Check that out. I bought 3 shares. I spent $430 buying this stock yesterday. It's one of my favorite stocks in the market. It has flawless financials. Flawless. And they're only at a 13 PE ratio. SoFi's at a 22 forward PE. SoFi as well is dog cheap. Like genuinely. SoFi, for the growth that they have, I can't believe that they're only at a 22 forward PE. SoFi only trades at 22 times next year's net income, and this is the growth that they have. Their revenue hits crazy growth rates. It grew 42% year over year, all organic, and not just 42% revenue growth, but record profitability. 166 mil in net income. It's projected to hit 240 mil in 2 quarters. So that's why I think people are starting to take SoFi serious. They have a great cheap valuation to buy in at current prices. Oh yeah, Toast. This is a restaurant software company. Now, specifically, if you look at any restaurant stock, like a McDonald's, Wendy's, General Mills, any food-related stock, they're struggling. And Toast, they do the point of sales stuff for restaurants. Dang, their website's not loading, but I think it's just weakness in their only restaurants are the only people buying their stuff. Like it's those machines where you pay with your credit card and it says, hey, would you like to leave a 50 or 100% tip? But yeah, the revenue grew 21%. The net income grew 125. I love the margin expansion. The highest margin they've ever had, a 7.7% net margin. I would not sell out of this stock if you were down on your position. Do not sell out of this company. They're actually undervalued, I think, at a 23 forward PE, but I still think it could go slightly lower. But I don't know why they're falling so much. They actually beat, I guess, slight miss on revenue, but they beat on net income, beat on EPS, beat on EBITDA. Let's see, is there any can we get like an earnings recap? They reported earnings. No, there's no earnings recap. Anyway, a 23 forward PE is actually really fair. So, and look at the net income projections. It's supposed to hit 121 mil a quarter after, 141 mil the quarter after, and they always beat by a big chunk on earnings. So, yeah. Should I buy Futu? I like Futu a lot. Actually, if you're wondering what is Futu, that is this app I am on right now. This app I am on right now is called Moomoo. It's publicly traded. If you look at the top, it's called Moomoo. And this stock right here is called Moomoo. So yeah, Futu, this stock I'm looking at right now is literally this app I'm on right now, publicly traded. And yeah, even if this company goes bankrupt, your assets are still safe, FDIC insured for $250K. But it's still great to see that this company is actually nowhere near bankruptcy. They're actually super profitable. They made 530 mil before tax, 433 million of net income after tax. If we zoom out, that's the most profitable net income they've ever had. This is what we're working with here. This is why I love Moomoo. They print net income. They're always doing giveaways on the app too. They make a lot in commissions. They collect interest income. The interest income is really cool. That grew 50% year over year. This app is free and it costs nothing. Again, if you'd like to get it, it's the link in my profile, link in bio. And this app for free gives you a 3.35% APY on their idle cash. That interest income is this money right here. They give you a 3.35% APY, but they collect like a 3.9% and they pocket the difference. Makes a great business model. Next up, let's see. Y'all sleeping on MELI, a lot of potential and still undervalued. So this is like an international Amazon. It's actually like a Brazil, South America Amazon. They do the same thing Amazon does. And actually, Michael Burry takes a stake in Mercado and MELI, targets 15% long-term return. So hey, he's projecting you buy the stock now. You should get 15% of your money back every year. So MELI, the only tough part is the valuation isn't cheap yet. Like this forward PE can still go lower, like it could still fall to like a 31 or a 32, and especially because of the increased Amazon competition. Amazon the other day announced they're expanding their 3-hour delivery service in the top 20 Brazil cities. And if we go to where this company's revenue comes from, Brazil is half of their revenue. So there's a lot of increased competition from Amazon, and it's hurting their margins. And it shows up in the numbers. It's actually a pretty bad margin decline. So revenue was great. Revenue increased 49% year over year. So revenue's up 49, but the net income actually declined by 15. So what that means is the net margin fell 43%. And that's real as well. Like the real operating profit fell 19, net income fell 15. So the net margin really did fall 43%, which is why the stock gapped down so aggressively on earnings. So that's the one tough part. A 37.4 PE isn't exactly cheap, but hey, you got Michael Burry taking a stake into them. What do you think about buying treasury bills? Yeah, so treasury bills is ticker symbol BIL. Actually, this is look at the dividend reinvested chart. So, I'm studying for my Series 65. The only asset that is considered risk-free by law is treasury bills because it's backed by the U.S. government. And check this out, BIL, you literally just get 3% of your money back every year. Actually, it has a 3.9% dividend yield. So basically, this is just government bonds, treasuries, and you just collect a dividend. Pretty cool. TLT is one I like a lot too. This is the US 20-year treasury bond. Basically, this follows what rates are doing. And last time, this is so cool to think. When rates were zero in 2020, this was $150. If rates ever again in your lifetime are at 0%, if rates are at 0% ever in history again, this is going back to $150 because this is how bonds work. Bonds have been so slow. So whenever bonds are down, yields are up because there's not a lot of faith in the bond market. So anyway, TLT is another great one where you not just only get the 4% dividend, but you capture the stock price appreciation of the bond whenever rates go down. That's why REITs and real estate's struggling right now. Like Lowe's, Home Depot, a lot of these REITs as well are struggling because of TLT. All right, next up, WBR won our stock pitch competition last night. Hey, what's up, Malachi? How's it going, man? WRB, let's check it out. WR Berkeley. I think this is a bank or some financial institution, if I remember correctly. I actually don't know. Let's find out. Insurance. Okay, so it's a property and casualty insurance company. And that's an industry that's really profitable. Insurance seems to always be milking us. Yeah, 83% of their revenue is insurance. So let's see what that translates to in net income. Yeah, after tax net income every quarter, it's like 400 or 500 million of net income. So what's the net margin on that? 13% net margin. So yeah, they really do print 500 million net income a quarter. Do they have a dividend? And they have a 0.54% dividend yield. And even though they're at an all-time high, they're only at a 13 forward PE. So, hey, Balds, thanks so much, man. Good luck on the Series 65. I passed the 7 and 66 a few months ago. Yo, that's awesome, Balds. We'll look at it. Dang, I just hit 3 hours live. All right, we'll look at like one or two more. I like VBIL. What is VBIL? The zero. Oh, I didn't even know this existed. There's BIL, which is the 1 to 3 week or VBIL. What's this one? 0 to 3 month treasury bills. Yeah. A 3.66% dividend and a lower expense ratio fee. So basically, you just get free dividends every month and you don't lose your original investment. But the cool thing is if you buy TLT, you can actually own the actual bond and capture the stock price appreciation. So yeah. What's next here? We'll look at hey, what's up, Sora? Yeah, Uber, we kind of just covered that one. We just covered that one 20 minutes ago. Oh, Coca-Cola Consolidated. Yo, this is a really cool Christian values company. This is the bottler, not the main Coca-Cola company. It's the bottler. I've met the CEO, Jay Harrison III. I've shaken his hand. Jay Harrison, he actually owns 70% of the voting rights. That's how he's able to keep this company Christian values. Like literally on their investor website, their main mission is to honor God in all they do. And now real publicly traded other companies can say that. They have like a chaplain or a pastor in all their bottling facilities. So and they return 1.5% of their before tax profit back to the community. It's just such a great company and good for shareholders as well. One cool thing they do with share buybacks, they bought back 28% of all the shares at $127 a share a couple months ago. So they bought back 25% of all the shares that exist. Look what that did. Here's what share buybacks do. The net income grew 7.6. So the net income's up by 7.6, the net income, but the net income per share grew by 40. How did the net income per share grow way faster than the net income? Well, it's because of the share buybacks. And check out what that does as well. Whenever you buy back your own shares, it makes the dividend cost less as well. They did not cut their dividend, but the dividend cost way less because of the share buybacks. It used to cost 21 mil. Now it only costs 16 mil for the dividends because of the share buybacks. Anyway, this is the bottling company for Coca-Cola. They bottle for Monster, Keurig, Dr. Pepper. Here's all the brands that they actually bottle for, Gold Peak, Monster, Core Power, Dr. Pepper, Fairlife, Body Armor, Minute Maid, Smart Water, Sprite, Coke, Dasani, Powerade, Topo Chico, Monster, all these great brands that I personally like myself. So one of my favorite staple plays, and they only trade at 23.6 times net income. I was actually just buying some more shares of this company not that long ago. So if it goes back lower to like this 150 is the golden spot. That's where I will personally be buying more shares of Coca-Cola Consolidated. So yeah, they just have really good pricing power. Why is down? I actually cannot figure out why they're down. Their earnings report was good. They had great earnings. Revenue was up 16, profits were up 25. Again, no analysts cover this one. This company actually doesn't do earnings calls because of the way the shares are structured. They don't do earnings calls. You don't get any voting rights. So no analyst can ask questions, and there is no financial future estimates from analysts because no analysts cover this stock right here. It's a niche name. But one I like, they're worth $11.5 billion. They bought the Coca-Cola affiliate rights in perpetuity for $1 a long time ago. Jay Harrison III, his original grandfather, bought the Coca-Cola affiliate rights permanently for $1 and also has an exclusive agreement where Coca-Cola they have to charge them the lowest syrup price that they charge any other customer. So Coca-Cola, the main company, sells them the syrups and then they bottle it. Kind of cool. All right. Hey, what's up, Pino? Good to see you, brother. One of the best analysts Hey, what's up, Fred? Good to see you. So QBTS, I love your streams. Hey, thanks, man. I'm actually going to end the stream here in a minute because I've been live for over 3 hours and my head's kind of starting to hurt. But I will be streaming tomorrow. I'm going to try and stream every day or potentially every other day throughout the summer because I'm finally free again. No more college classes and stuff for the summer. So yeah, anyway, unfortunately, maybe this is a good time for my thing to freeze. My screen cache just disconnected. So my phone isn't even connected to my computer anymore. So something just happened with the Wi-Fi. I really hope that fixes it really soon. If it doesn't fix in a minute here, I'll just end the stream. But yeah, by the way, the best way to support me if you want to is just watch the stream from YouTube. I'm also streaming on YouTube as well. And you can rewind the stream, watch in the beginning. Yeah, I usually stream every day around 12 p.m. Eastern. So yeah. Yeah, I really am. That's really odd. Maybe my application broke or something. Well, there we go. There we go. Hey, well, hopefully it doesn't lag. Okay. Well, if it lags, then oh well. Well, it looks like we're back. So anyway. Last stock here. Oh yeah, QBTS. Oh yeah, that was the stock we were looking at. QBTS. This is your quantum computing company. It's tough to, as you know, this is mainly a day trade swing trading stock. Yeah, 12 p.m. Eastern time. Yep, like New York time. 12 p.m. New York time is when I usually stream every day. Or 3 hours before the current time. It's literally 3 p.m. right now exactly. I started the stream 3 hours ago exactly. So yeah, 3 hours before now is usually when I start streams. So D-Wave Quantum, this is a quantum computing company. Basically, they're trying to get computers to go quantum speed, make them work even faster. But how much faster can these computers even go? I feel like we're already there. But the thing is, they have some revenue growth. Like the revenue is supposed to hit 13 million in 2 quarters, which still like, even if they do 13 mil of revenue a quarter, it's still tough to justify an $8 billion market cap on QBTS, but I know that doesn't matter because this stock just trades off momentum and just the sentiment around all quantum names. Is there any other specific news here? Q1 revenue falls 81%. Bookings surged 2,000% to 33 million. So they have a $33 million order. Wow. Florida Atlantic University did a 10 million order and a Fortune 100 company. So anyway, interesting there. There's this, it's a niche one. Oh, you're in Thailand. It's 2 a.m. there. Oh, nice. Dang, you're up late. TMBY. I didn't go over Coke's earnings with a fine tooth, but EPS is down. Yeah, there was like this weird adjustment that they have where the net income actually like grew, but it was like the sales didn't grow as much as stated, so it makes the margins look like they went down, but the gross margins didn't go down as much as they said. But let's check out wait. Oh, wait, you're saying his name right there. What do you think of SNCAF? SNCAF. I hope I can find that stock for you. Yeah, unfortunately, I can't find that company because they're an ADR. Actually, I bet there's a different ticker symbol. So if you give me the name of that company, I bet I can find that stock. But I could not find that one, unfortunately. Hey, what's up, Plasma? Good to see you, man. Hope you're having a good day. I'm actually about to end the stream right now. What's your favorite quantum computing stock? It's obviously not a pure play, but like Google, I've seen their quantum. They're ahead. I mean, Google has the money and the talent to be the industry leader. They will be the industry leader. Google in talks with SpaceX for rocket launch deal to support orbital data center plans. That is so stupid, kind of. Orbital data centers, low Earth orbit. I wonder if that'll actually be profitable. But Quanta IONQ is decent. I actually think I like IONQ more than QBTS, but they're worth 20 billion. It's still like this stock is ridiculously overvalued, but this one has a lot more revenue. They're also doing acquisitions. They actually just acquired and merged with Skywater Technologies, which is another publicly traded stock that makes net income. So they're acquiring a business that makes net income. Atkins. Let's see. Atkins. Atkins Real. Oh, ATRL. I think this is it right here. So Atkins, it's a Canadian company. So we'll convert the currency from Canadian to US dollars. So here's where the revenue comes from. They do nuclear, huh? And they're also in like UK's 30% of the revenue, Canada's 25%, US is 20%, other countries are 16%. So the revenue is great. It's 2.14 billion, and they're profitable on that. They made 140 mil of profits. So let me pull up their website here. They're in the construction industry, headquartered in Montreal. So here's their website right here. They're trying to get my cookies. Oh my, you know what? We're going to not check out their website. A wide range of services, including financing, consulting, and engineering, construction, procurement, operations, and maintenance. Wait, what did the second line say? The firm serves clients in the nuclear and engineering design industry. It owns infrastructure projects. Cool. Any specific news? There looks like they're about to. Atkins acquires Australian-based defense consultancy Coros. Expands their strategy to expand its footprint in Australia and accelerate growth in key markets, specifically defense. Cool. All right. Does Moomoo have paper trading? Yeah, it does. And there's even like paper trading competitions on this app. Actually, how do I find that? Actually, I have my own on your profile. You can like display called like a Moo folio where you like paper trade stuff. But yeah, paper trading, you just click on a stock right here. There's even a challenge right now. Actually, let me see if I can find that. I always forget how to get to it. Maybe is it in the promotions tab? I don't know. But yeah, you definitely, here's how you do it. You go here. It should be on this screen, but I've removed it. Yeah, paper trade. Yeah. So here's the paper trade thing right here. I'm ranked 1,300. There's a competition right now where they give you like, I don't even know. Oh yeah, first place gets 300 of NVIDIA stock. Second place gets like 200 of NVIDIA stock. And anyway, this is a cool brokerage. You're always doing fun stuff to like give back to the community. Hey, if you want to get this app, I'm on Moomoo. I have a link in my bio there for an affiliate link. But yeah, anyway, that pretty much wraps up the stream. Nuclear division with NVIDIA partnership engineering company. Oh, hey, that's really cool. So yeah, let me end the stream off by doing a portfolio update. I know the market's a little red today. The market actually closes in 50 minutes. So yeah, here's my Moomoo portfolio in the top right. We are down 1.81% on the day, but I'm not too worried. I mean, Powell Industries is down 600. Comfort Systems is down 300. Both of those stocks actually hit an all-time high yesterday. So they're kind of just having a healthy RSI retrace. Then we have our Webull portfolio, which at the top, we are down 2.24% on the day, and we're only up 21% all time. Oh, here's my lifetime performance in this portfolio. Yeah, we're up 73% year to date, or $34,000 all time in this portfolio. But all time in this portfolio, we're only up $3,300 or 21%. Yeah, mainly the big losses on the day are AMD, Power Solutions, UiPath, a lot of software like Reddit's down 5, UiPath is down 5, Dave is down 4. Actually, I just bought a $450 more of Futu stock. I think this one's a steal of a deal. The blue line is my cost basis line there. That's one of my favorite buys right now. And then we have our Robinhood portfolio. This is known in the top left as our dividend-only account, where every stock in here pays a dividend. But most of these, as you can see, are like dividend growth companies like Google, McDonald's, Meta, Constellation Energy, Carlyle. Yeah, here's our total percent change. The only stock we're down on is McDonald's. And year to date, we're up 1.5. And over the past year, we're only up 16%. And if we compare that to the S&P 500, that underperforms because the S&P is up 7% year to date, and it's up 27% from a year ago. So even though we haven't outperformed, I'm still not complaining around a 17% return. Oh yeah, we also have a Roth IRA. Roth IRA is down on the day, mainly from InnoData. They've had even though they're down 14% on the day, they're up still 95% on the week, and we're up 163% all time in there. But anyway, that was the stream. If you want to support me, just leave a like. That's the best way to hit the follow button. I sell nothing. I have no course book. Oh, I guess I have a private Discord. It literally costs $1 to join. If you'd like to join my Discord, I made it the least amount of money possible just to keep. I literally have not talked about it a single time. I never mentioned the Discord, but yeah, it costs $1 to join. It's in the link tree in the description, or it's actually, if you're on TikTok, you can't really join it. You have to go on YouTube and look in the description there. But also, if you become a YouTube member, you get permanent access to the Discord as well. So if you become a YouTube member, even if you cancel it the next month, you still stay in the Discord forever. So anyway, it just costs $1 to join, link in the description. But anyway, that's the stream. Have a great day. See you soon. Thanks to everyone. Please hit the like if you haven't already. This was a 3-hour and 50-minute stream. My head's starting to hurt. Thanks again. See you, my music and Sora and everyone.